Daily bias by far is the most important thing in all of trading, and without daily bias, it doesn't matter how good your entry pattern is, you will not become a consistently profitable trader. So in this video, I'm going to teach you what daily bias is and how we can use it to consistently predict price action and become profitable traders. But let's get into the video. Okay, so what even is daily bias? Daily bias, in its most simplest form, is just a higher time frame direction. It literally is, where is price going to go on the higher time frame? That's it. It's that simple. Now, why do we care about the higher time frame? The higher time frame move the market. Those who have billions, so smart money, big banks, hedge funds, insurance companies, they only trade on the daily and the 4-hour chart, right? But this is the key chart that all of smart money, everyone with billions are looking at. So we want to ride, essentially, we want to follow the trend that smart money, these big institutions are doing, right? That's what we want to do. So
there's only 3 time frames that you actually need for daily bias, and those are the weekly, the daily, and the 4-hour chart. Now you need to use it in that order, right? So you have to start with the weekly, go on to the daily, and then the 4-hour chart, right? So you've got to use all 3 of them. Now, what we're going to do is we're going to start off on the weekly chart. Now, this example right here on dollar yen is the hardest example that I can give you, right? It's the hardest example. I went through all my watch lists, right? I scrolled through each and every single pair, and USDJPY by far is the hardest example. So if you can understand this, you will understand literally any pair, any asset, anything that you trade. So run the weekly chart, and the first thing you want to do on the weekly chart is you want to look at the most recent price action, right? We want to look at the most recent price action over here. Right? We don't care about, this order block all the way down here. We don't care about this. We care about, what's actually relevant to us. And this is the current weekly chart candlestick, right? So this is today's price action right here. So we care about this recent price action here. That's the only thing that we care about. And the first thing that I see, and for those who don't know, I always do my analysis live. So what I mean by that is I haven't gone below the daily or 4-hour chart on this, right? So this, I'm literally telling you exactly what I would do when I get on the chart. So the first thing I'm seeing here, I don't know if you guys see it, but if you've watched my channel for a long time, you'll know, right? And I'm sure most people know, at this low here, there's lots of liquidity. So let's mark out this low here, right? And this is what you always want to do, right? You always want to look at liquidity first, right? Liquidity is king. So we always look for liquidity first when determining daily bias, right? We want to look at old highs and old lows. So old lows here and old highs here. Now, at this low here, there's lots of liquidity. Lots and lots of stop loss orders at this low, right here. And you see this? You see this wick? How we come down, we wick out this low, and instantly reverse. That right there is a liquidity sweep, right? Very, very important. And if you don't understand liquidity sweeps, don't worry. There's a full, completely free 2-hour trading course where I go into stupid detail about liquidity sweeps. But if you understand liquidity sweeps, you'll know exactly what I'm talking about here, right? Because what price really does, what price really did, is you see how we were dead bullish, right? Price came all the way down. It took out liquidity here. Remember, this is the weekly chart, right? This isn't the 5-minute or 1-minute chart. This is a major time frame that all the banks, all the hedge funds, all of smart money, everyone's looking at this chart. Everyone's looking at this chart, and only smart money move the weekly chart, right? Retail can move the 1-minute chart, but smart money are moving the weekly chart. And at this low here, lots of liquidity. Price comes down, it wicks out this low, instantly starts reversing. That right there is a very bullish sign. Very, very, very bullish sign. So that's the first thing that I noticed. So let me just mark this out. Let's actually write this down here. This is what you always do, right? So when you get onto your charts, the first thing you want to look for is liquidity. Now that liquidity has been swept at this low here, the next thing we do is we study this high here, right? Has the liquidity been taken here? No, right? And this is really, really important. Really, really important right here. Here is a fair value gap, right? This is a bearish fair value gap. And let's mark this out like this. This is our bearish fair value gap. Now, can you see how price literally comes all the way up, taps it, and then instantly reverses off in the opposite direction, right? You see how price, we have our liquidity sweep, like this. Price comes all the way up, it taps this fair value gap, and then starts to retrace, right? That right there is bearish, right? That's bearish. Now, you might get confused, and this is why I said this is a very difficult example. You might be like, oh, see, if we had a liquidity sweep, and if we just zoom out a bit, like this, the overall direction is bullish, right? What's actually going on here? What's actually going on here? And for those who don't know, right, on Twitter or X, I called this live, right? When we were all the way down here, I called this, and we're going to hit this fair value gap. So there's me bragging a bit, but but if you if you follow me on X, you'll know what I'm talking about. But what's really going on here, and it's just so important that you understand this, right? If we zoom out, we are in an overall bullish trend, right? Pretty obvious. If you ask anyone, what trend is this, right? What trend is this on the weekly chart? Oh, this is a bullish trend. What's actually going on here, right, is price is at all-time highs on yen. This is all-time highs. Now, obviously at all-time highs, there's no liquidity, right? No one's shorting at all-time highs, right? No one's gonna, imagine if this was the highest candlestick and none of these down close candlesticks were here. No one's gonna start putting their stop loss orders at all-time highs, right? Only now, when price starts to come all the way down, to allow people to start shorting, and by people I mean major banks start putting their stop loss orders here. Right? They're shorting on the weekly chart because they see price comes down. Now price is actually going down to take out stop loss orders here. Right? It comes down, it takes out stop loss orders here, and it instantly and aggressively reverses in the opposite direction. Now you might be wondering, okay, what's happening here, T? Like, what's actually going on here? Why have we hit this bearish fair value gap and started to retrace? The reason we've done that, this is so important, it's something for your notes, right? Is price doesn't move in straight lines, right? It doesn't move in straight lines. Now, smart money traders who are going to target this high, so let's mark this out, right? Let's mark this out all the way like this. This right here is, it's a bit of a weird line, but let me just do it like that. Right, this right here is liquidity, right? This is our major liquidity, and what's really important about this is all-time highs. So I'm just going to mark this out as ATH. Liquidity, this is all-time highs. This is the highest that yen has ever been. And some people, for whatever reason, are obsessed with picking all-time highs, right? You see this on, the S&P and NASDAQ. People are just obsessed with picking all-time highs, trying to capture some major gamble where, it drops 10, 20%. You don't need to do that. But some people, for whatever reason, they're shorting here and they're putting their stop loss orders at this high here, right? There is liquidity here overall. And if you zoom out, the overall direction of this market is bullish, like we said. Now, towards the end of this video, and for those who still watch, I'm going to give you something very, very advanced that will probably change your trading forever. But that's a little golden nugget, and it will make a lot more sense on why price is actually bullish overall and why we're taking out this liquidity. But you can see what's going on in this price action alone, right? Because I don't want to make it too complicated for you. What's really going on here is we've had our liquidity sweep. The overall direction is bullish. Is we are looking to target this high. Now, price doesn't go in straight lines. So what I mean by that is price is really, remember this is our liquidity sweep, right? Price is coming down to allow smart money traders to start buying at this fair value gap, this order block, optimal trade entry, to do that, right? The exact same thing, remember, this is the exact same thing we see on the 1 minute, 5 minute, 4 hour chart, 15-minute chart. The exact same thing where we have liquidity sweep, obvious liquidity, retracement. The exact same thing happens on all time frames, right? And you might hear ICT or other people say price is fractal. What they mean by that is this, right? The exact same thing that happens on the 1 minute chart happens on the weekly chart. Now, what that means for us as traders, we're not trading the weekly chart, is it means for us overall direction is bullish, right? The overall direction is bullish because if we just look at this fair value gap here, this bullish fair value gap, right? Mark this out here. Price comes out, look at this, right? See how we wick into the fair value gap and then we instantly start moving off in the opposite direction on the weekly chart. That right there is very, very bullish. And another thing that's really important is if we get the Fibonacci from this low to this high, right? Anything below the 50%, this light green line here is the 50%. Anything below the 50% level is a good buy, right? Smart money traders will not buy until price gets into the lower 50% level, right, of a price swing. They will not buy until price gets into this lower 50%, right? Very, very important. They're not going to buy up here. They're only going to buy when it's in the lower 50%, right? And remember, you might be thinking, oh, well, who's trading the weekly chart? Smart money traders are literally buying the weekly chart. They're buying this fair value gap with their stop loss hit order here, targeting all-time highs, and they'll hold on for months, as long as it takes, right? Because they have the money to do so. Now, we're not doing that, but by studying what they're doing, we can almost get on their pigtails, right? We can almost copy what they're doing, right? And pick up some crumbs that they leave behind. But those crumbs are worth, thousands, millions. So for them, you've got to remember, they're trading billions, right? So, a few million, it doesn't mean anything to them, right? So they're doing all their orders, all their analysis on the weekly chart. And if we see, below the 50%, just look at this, right? Look at this. So you see how price starts gapping down, right? Strong, aggressive candles down. Look what happens when we hit the 50% level, right? Look at what happens when we hit the 50% level. This body here almost respects it perfectly. We have a bit of bullish movement here. Okay, we have this candle here, this bearish candle, but where did it go? Look at this candle, where does it go? It wicks straight into the fair value gap. And then this candle here almost fills the fair value gap entirely, and then we start to shoot off. And now we're above the 50% level, right? Very, very important. Okay, so once you've got your liquidity, right, so we've looked at liquidity here, and then you've looked at your fair value gaps, here, and here. The next thing you want to do is you want to start looking at order blocks, right? Now, on the weekly chart, we don't even hit this order block. We don't hit it. Let me just make this very clear. We zoom all the way out like this, right? All the way out like this. We just miss out on it, right? This is the fair value gap. We just miss out on the order block. That right there is incredibly bullish. Right? A lot of people get confused by that. That's incredibly bullish. The fact that price, and let's zoom out, the fact that price couldn't come all the way down and touch the order block here is very, very bullish, right? Normally I say I want price to hit it and aggressively shoot off. If price doesn't even hit it and start shooting off, that's even more, I guess, supports the argument that we're bullish, right? Because price is so bullish it couldn't even get to that point. So that right there is what I normally do on the weekly chart. I look for liquidity overall. I want to see, is price sweeping highs and lows? Where's the overall direction? Then I look at fair value gaps, which sides are being respected, and then I look at order blocks too, just in case. But liquidity and fair value gaps are like my bread and butter. Those are the two things that I really look for. And this is so important now. We've done the analysis on the weekly chart. We know overall that we're bullish, right? We've swept liquidity here. We've got all-time highs here. If we zoom out like this, we said this, the overall trend for years, remember, this is the weekly chart, right? So if I've got, this is 2021, right? It's 2020. This is 4 years of price action here. Remember, this is the weekly chart. The overall trend for years is bullish, right? So I've got the overall weekly trend, macro trend. We've got liquidity, fair value gaps are being respected. I want to get on the daily chart, and I want to see the daily chart showing me similar things. I don't want the daily chart to be bearish. I don't want the 4 hour chart to be bearish, and then the 1 hour chart to be bullish. I don't want any of that. I want everything in agreement. I don't know about you. I'm a swing trader. I hold for at most 2 weeks. If you're a day trader, you don't even care about this. What we care about is the most recent price action. So we're only going to look at the last 3 or 4 candlesticks just to give us an idea of what the market's doing overall, right? So for me, and I'm doing this live, by the way, I haven't really looked below the weekly chart for gold or silver, but I'm going to do it live in this video in front of you, just so you know what it's like for a profitable trader to think and analyze these markets, because it's very, very important that you understand that. There's no script. I'm just going to tell you live in price action what I see. And the first thing I see here, right, is you see this big bullish fair value gap. Right, so smart this out. This big bullish fair value gap here, like that. Look at this. You see how price wicks into it and it instantly shoots off on the weekly chart, right? These big bullish candles instantly shoots off once we hit this fair value gap, right? And if you look very carefully, I know the body slightly closes into the fair value gap, but it's mainly just a wick, right? It's mainly just a wick like this. Price comes in and then quickly and aggressively shoots off, right? What that's called is respect of a fair value gap, right? You might hear this all the time in trading. Price has respected this CB, this fair value gap, this order block, this breaker block. What respect means is that price has tapped it and it's quickly moved off in the opposite direction, right? That's all respect means. Now, in this case, the reason we actually care about this is this tells us that we're very, very bullish, right? The fact that price wicked into the fair value gap, massively, aggressively moved off in the opposite direction. That tells us that we're super bullish on gold, right? Because if price did something like this, if it went into the fair value gap like this, and then it just started consolidating for ages, that is not bullish at all, right? And if it started to break this fair value gap and go down, that's bearish. But the fact that price, let's just remove this, the fact that price tapped the fair value gap like this and instantly shot off aggressively and left another bullish fair value gap here, that tells us that we're very, very bullish, right? So we're going to operate with that lens on the weekly chart that we're bullish. Now, what I mean by that is when we get on the daily 4 hour chart, we're going to, assume the overall direction is bullish, right? We're not going to look for a market structure shift on the 1 hour chart. We're just going to look for the overall direction of the market. So now that we've got the direction on the weekly chart, we want to get onto the daily chart and see what we can see. Here we are on the daily chart, and like we said on the weekly chart, overall we are bullish. Now, I know lots of smart money traders are going to be like, oh, look, Atif, market structure shift. Yeah, look, you can take trades here, but look at these candlesticks. Look at this, right? Look at these strong bullish candlesticks. There's one down close candle here. Right, look at this, from this low to this, guess this bit here, or this high here, right? Or this high here, this liquidity pool here. Look at all these strong, aggressive, green up close candles. You have one little down close candle. And then look at the way down. Look at all these choppy, large wicks. For every red candle, there's a green candle, right? Very choppy, very lethargic. We slowly, look at all these dojis here. We slowly take it out. That right there is telling us that we're bullish overall, but price is slowly coming down just to allow smart money traders to buy the dip, right? Buy cheap. And we talked about that on the weekly chart, because what's really happening here is overall we're bullish. Look at how strong the bullish candles are compared to the bearish candles. What's really going on is it's just allowing smart money to buy at the below the 50% level, right? That's what's really going on here. So all of this right here is accumulation. Look at all these dojis here. This is smart money buying, 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 and telling their friends to buy. That's what this is. Smart money buying, buying, buying. They're accumulating all their orders here. And then what they're going to do is they're going to ride price all the way up to this, right? Ride price all the way up like this. All the way up like that. Now, we don't care about, we don't have to trade the daily chart, but we can trade in this direction using the exact same logic they're doing. So that's the reason why price comes down. Lots of traders are going to get chopped up, shorting dollar yen, and then they're going to lose a lot of money. Like, who wants to be in this mess here? Like, who wants to be shorting dollar yen in it? Yeah, okay, you get a few good moves here, but who wants to be shorting these large weights? Because what's going to happen here, and you're going to see this all the time, you're going to short, right? You're going to have a liquidity sweep, and you're going to do what I tell you, right? You're going to put your stop loss at this liquidity sweep, and it's going to get swept again, and then it will come down, and it will just chop around, it will take out lows, take out highs, and it will just be the awful price action that will just confuse you, blow your prop firm account, and break you. Because trust me, I've done this for a long time. You just want to avoid this price action. But what we want to do now that we know that, now that we understand the overall direction is bullish, is we want to start studying fair value gaps and order blocks now, right? So let me just make this very clear. Right here is an order block. So let me just mark this out. This is an order block, and it'll be clear on the 4-hour chart, but I just want to show you on the daily chart. Right here is an order block. Price wicks in, instantly shoots off in the opposite direction. Very, very, very nice, right? We always like to see that. But this price action here, we have a fair value gap. So let's mark this out. Fair value gap here. And again, price does not touch it. It comes down, comes close to it, but now we're starting to move off in the opposite direction. Now, I want to get onto the 4-hour chart because this is getting a bit messy now, but just remember the overall logic that we had on the daily and 4-hour chart, right? Sorry, the daily and the weekly chart. Weekly, we're bullish overall, liquidity sweep, all-time highs of liquidity. Daily chart is just retracing to allow smart money traders to buy in this fair value gap, in these order blocks, just allowing smart money to buy before we ride price all the way up to all-time high. So we're going to get on the 4-hour chart and we're going to look through that lens, right? I'm not going to look on the 4-hour chart and think, oh, how can I short this? Like, I'm not going to do any of that. I'm only going to look for longs, and more importantly, I'm going to look for targets on the 4-hour chart. Okay, so here we are on the daily chart, and now when I'm on the daily chart, I just want to see confirmation of the weekly chart, right? On the weekly chart, we're bullish, and I just want to see the daily chart show us that we're also bullish, right? I'm just looking for confirmation because this is some of your notes. The higher time frame is king. Now, what I mean by that is the higher time frame direction is what the overall market direction is. So if the weekly is bullish and the daily's bearish or the daily's neutral, I'm still going to go with the weekly direction because it's a higher time frame, right? Same thing if the daily is very bullish, but the 4 hours consolidating, I'm still going to go with the overall direction of the daily chart, right? So all else being equal, the higher time frame is the most important, right? So that if the higher time frame is bullish, we're going to trade in that direction. So the weekly chart, like we said, was bullish, and I just want to see the same thing on the daily chart. So what does that actually look like? I want to see order blocks and fair value gaps get respected. So let's just suppose, let's do it like this actually. Let's suppose this is like a fair value gap, right? So use your imagination. Let's imagine this is a fair value gap here, and it's a bullish fair value gap. I want to see price touch this fair value gap with like a wick and then quickly shoot off, right? Because that would show me that we're bullish, right? I do not want to see, let's just remove this. I don't want to see price consolidate, right? I don't want to see it hit a fair value gap, consolidate, and I definitely don't want to see it start to break all the way down, unless it's like, a liquidity sweep and we quickly reverse, right? So that's just my thinking process. Every time I get onto the charts, that's my thinking process when I do my analysis. And here we are on the daily chart. And the first thing I'm looking at is this wick here. Can you see this fair value gap? Let me just round this out. Right, now don't worry, this is going quite fast because with experience, you're going to get better. So I'm going to give you a high level overview. And, there's only so much I can teach you in a YouTube video. And obviously I don't want this to be like 2 hours long, but I'm just giving you my thought process. And can you see how we had, let me mark this out. You see how we had this fair value gap here? Right, and you see how price wicks into it and then aggressively shoots off. I know we get a bit of consolidation here. The reason we get that, by the way, for those who are wondering, is price is essentially generating liquidity. Now, I can get very, very complicated with this. So $3,000 was our higher time frame target for gold, right? This was all-time high. So what What was really going on here is the market makers or smart money was trying to get people to short gold, right? Because no one wanted to short gold at all-time highs. But when price started to drop, lots of people felt confident putting their stop loss orders here, and then price shoots off and smashes those orders, right? Very advanced that, you don't need to know that. But what we do need to know is, first of all, this. You see this fair value gap here? You see how price wicks into it, instantly shoots off. That tells us that we're bullish. But the next thing that's really important, and this is some of your notes, you see this fair value gap here, right? There's part of the fair value gap that's remaining. And you see that there's part of this fair value gap that's remaining. This bit here has been filled by this wick, but there's part of the fair value gap that's remaining. This wick here, so let's zoom out. This wick here comes all the way down, taps that remaining fair value gap, instantly shoots off. That is very, very, very bullish. Now, why is that really bullish? Because there's two things that's happened. Prices come down to fill out this fair value gap, even more of it. And more importantly, this is actually a liquidity sweep, right? Because you gotta remember, this is the daily chart. This is the daily chart. So this is the previous day's low. Price comes down, takes out liquidity at this low, instantly reverses off in the opposite direction. I mean, just look at this wick here, right? Look at this wick, right? Price comes down just enough to take out anyone who had their stop loss orders at this previous day's low, and it hits the fair value gap and then massively shoots off, right? I mean, I literally have to zoom out of the chart just to see how fast price zoomed off, right? Very, very, very bullish, right? Very bullish, because what price has done, it's taken liquidity and it's hit a fair value gap, right? Very, very, very strong price action. And this is telling me that gold is super bullish, right? I've not even looked at any of these candlesticks here, but just by studying this, I already know my direction of the market, right? And I'm still bullish. And I'm not getting confused by any sort of bearish fair value gap here, any bearish order block. I'm not trying to short on the lower time frames. I'm just following the overall direction. Now, the second thing I'm looking for, there's no fair value gap here, which is pretty interesting. This right here is your order block. And if you remember, it was actually also a liquidity sweep of this low, right? But this is your order block here, right? And for those who don't know, order block is just the last down close candle before the up move, right? That's what a bullish order block is. So realistically, this whole thing is an order block, right? This whole thing's an order block, but this is something that's really, really important, right? So the body of the order block, that is the most important part of the order block. That's almost like, it's almost the meat of the move, right? Now, if you study like VWAP volume profile, and don't worry if you haven't, but if you have, you will remember, like, you know, on the side of the charts where it shows you that like normal curve like that, right? That's what an order block is. That's what the body of the order block is. It's that little bell shape on the volume profile, right? Where there's lots of transactions occurred. That's what the body of the order block is. Now, if you don't know what that means, that's absolutely fine. But I paid a lot of money for a course on that, and I know a few other people have. If you understand that, you'll understand that that's what the volume profile actually is. It's just the body of the order block. It's just where all the transactions were. But if you don't know anything about the volume profile, don't worry. All you need to know is the bodies it's essentially what smart money trading is, right? Smart money, they're the ones who are moving price, right? The wicks are retail, and the bodies is smart money, right? The body is smart money's movement, their footprint into the market, right? That's what the bodies actually are. So the body of the order block is very, very important, very, very significant. And the fact that we haven't touched the body of the order block, that tells me that we're very bullish, because, and this is some of your notes, right? This is ICT chart stuff here. So if you've got a bullish order block, right, like this, and price doesn't even touch the body, but it touches the upper part of the wick, that is incredibly bullish. So what I mean by that is this whole candlestick is an order block, right? This whole candlestick here is an order block. You see this wick here? This is still part of the order block, but you see how price wicks into it, instantly shoots off. That tells us that we're so bullish that we couldn't even tap the body of the order block, right? We couldn't even tap the body of the order block, right? We could only tap the upper part of the wick of the order block, and then we had to quickly and aggressively reverse in the opposite direction. That tells me we are incredibly bullish. So for me, like, just from the weekly and daily, I would already be looking for longs. But of course, top-down analysis video, I want to give you, I guess, the full analysis. And let's see what else we have here. Okay, so first thing I'm looking at is, you see this fair value gap up here. Smart this out all the way. This right here is our fair value gap. Now, price wicks a bit below bit below the fair value gap here. Now, I want to know on the 4-hour chart why that is, because it's a bit hard to see in the daily chart what's actually here, right? We've got a doji candle, and we've just got a bullish candle here, right? We've got no fair value gaps. At this point here, I'm going to get on the 4-hour chart. Now, remember, when we get on the 4-hour chart, we're looking for longs. I want to see bullish price action. I don't want to see, you know, let me show you. I don't want to see like a 4-hour bearish market structure shift. Oh, you know, technically price has gone below an old low, so I have to start shorting. I don't want to see any of that. I'm only looking for longs, and ideally, I'm really looking for liquidity sweeps, because what I want to see is an entry like this, right, where this is a liquidity, this is your liquidity sweep, right? Let's say equal highs, high probability retracement here, ride price up, right? That's what a swing trader would look for on the 4-hour chart, and you do the exact same thing on the 5-minute, 1-minute, and 15-minute chart. But don't worry about that. We'll talk about entries in, you know, there's plenty of videos where we talk about entries. Let's get onto the 4-hour chart and see what we can see. Like I said, I've not seen the 4-hour chart, so I just want to show you what my thoughts are. So the first thing I want to see is I just want to see order blocks getting respected. And if we look at this down close candle here, let me mark it out, right? This candle right here. Look at how price respects it beautifully. Look at that. Let me just mark the body out. Right, we just look at that. Look at the wicks. We just tap the order block's body twice, and then we shoot off aggressively and massively in the opposite direction. Let's just zoom all the way out. We shoot off aggressively in the opposite direction. What this means is the order flow, and the order flow just means the overall direction is bullish, right? So don't get confused by the terminology with order flow, liquidity sweeps. Liquidity sweep is just a stop run. Liquidity is just stop loss orders. Order flow is just a direction on whatever time frame they're talking about. And don't get a lot of people want to sound smart. A lot of people want to sound smart, but you know, it's very, very simple when you start to understand what's actually going on. So this order block's being respected. And this order block here, and again, this is what I always like to see. So let's mark this out. Here's a bullish order block that price doesn't touch. Does not touch it. Very, very nice to see that, right? Because like I said, you know, usually you want to see price hit it, quickly and aggressively move off in the opposite direction. If price does not even touch it, because it's so bullish, that's an even stronger sign. That's an even stronger sign that price is bullish, right? So now that we've studied our price action, we've done all the hard work on the higher time frames. Now I want to look for targets. Where's the most obvious liquidity target? And if we zoom out to the left-hand side of the chart, where is the most obvious liquidity target? And I'm literally telling you guys before I've even spoke about it. This is our obvious liquidity. Now, why? Let's just suppose this was bearish, right? So let's just suppose this was a bearish order block. Does that look like price has respected the order block, the bearish order block? No, not at all. Look how deep we've retraced, right? We've almost retraced 75% into the order block, right? That is not bearish at all. If price was bearish, it would tap the order block, almost like it did here. It would tap the order block and then quickly move off like that, right? We don't have that at all. In fact, we've got price respecting bullish order blocks, completely disrespecting bearish order blocks. That's exactly what we want to see. And at this point here, we're just looking for our targets. So at this high here is our liquidity. And for those who are wondering, oh, you know, see, why is there not liquidity at this low or this low here? This is why. This is how we actually know that price is going to go through the liquidity, by doing the higher time frame analysis, daily buys, all the boring but profitable stuff. That's how you actually know and that this liquidity pool is going to get taken, right? Like, I'm not looking at this low, you know, when price retraces. I'm not going to think, oh, you know, there's liquidity here, price is going to take it. I'm only looking at this high because we've done all the analysis on the higher time frame. So let's just mark this out. So right here is liquidity. And for those who always get confused about what liquidity actually is, it's just stop loss orders, right? It's where the money is, because these large banks, hedge funds can only get into their positions and out of their positions where there's billions and billions of dollars. And on dollar yen, on the 4-hour chart, there are billions of dollars at this high here, right? And at this low here, right? Very, very important. That. So price is going to go and target these highs here. Now, what does that mean? What does this really mean? All of this, you know, analysis that I've told you on the higher time frame that we have all-time highs. What does it actually mean for us as traders? So this is where things get a bit, not difficult, but it's different for every single trader depending on what your trading model actually is. For me, as a 4-hour chart trader, right, as a swing trader, I'm just looking for longs, right? So this would be an example of my entry. Like this, right? Fibonacci, I enter at the 0.705 level. There's no magic in this number. There's no, you know, secret Fibonacci. It's just an easy way of entering it. And I learned from ICT, and this is what he used, so I just stuck with it. This is my entry, my very sophisticated advanced entry. Just in the Fibonacci retracement, I target a 3-to-1 in a direction. Notice how I don't target the actual liquidity pool itself, because you don't really need to, right? Price could retrace. So for me, I'm happy, and I strongly recommend you either just aim for a 2 or 3 risk to reward ratio in the liquidity direction. You don't have to target liquidity. You don't have to do anything fancy, especially as a day trader. I get people telling me, you know, as a day trader, let's just imagine this is the 1 minute chart, right? All the way over here, and the stop loss is like this, right? This is the 1 minute chart, and they're like, oh, Atif, do I have to target this liquidity pool on the day? No, no, you don't. We just have to trade in the direction. So let's just remove this. And that's what a swing trader would do. You just ride price up. If you're a day trader, scalper, any of that sort of stuff, you're going to get onto your entry time frame, and you're just going to take every single long entry you see. You're not going to take any bearish entry. You're not going to try and short down to this fair value gap. You're just going to take any bullish entry to this liquidity pool here. Okay, here we are on the 4-hour chart, and right here, I mean, I guess the first thing that comes to my mind is you see this order block here. Let's mark this out. Right, this candle here, candlestick here is your order block. This also could be order block. Doesn't really matter. I guess you could have this one too, but for me, I either see this one here, where the first bullish move was, or this one here. Right, doesn't really matter. You can choose any. And let's just suppose you chose this as your order block. Right, this would be your order block. And do you remember what I said last time? Right, if price can't even touch the body of the order block here, if it can't even touch the body of the order block, and it just shoots off before even touching it, right? So if it just shoots off by touching the wicks, that right there is incredibly bullish. It's incredibly bullish because it's telling us price wasn't even weak enough to touch the body of the order block, right? It could only touch top part of the wick, and it quickly and aggressively shot. That's what we always want to see. Again, on the 4-hour chart, we're even more bullish. Let's just make this super clear, right? So this is the upper part of the order block, right? This is the wick here. Look how look at this, right? Look how we wick into it instantly and aggressively move off in the opposite direction. That right there is exactly what respect of an order block, respect of a fair value gap, respect of a breaker block, whatever you want to call them. That is what respect of a PD array is. Right? When price comes down, it touches the key level and it quickly moves off in the opposite direction. That's exactly what we want to see. And that there is even more confirmation that we're bullish, right? Even more confirmation that we're bullish now. This bit of price, I'm just looking at this, I guess live, right? This bit of price action's a bit messy. It's a bit choppy. We took what did we take? $3,000 all the way down here, and then we just consolidated for a bit. A little bit of a retracement. Again, so many people are going to fall for this. They're going to think this 4-hour candlestick closed below this low and this low, so it's a bearish market structure shift. A complete load of crap, honestly, a complete load of crap. Look at all the analysis we've done. Are you really going to start shorting gold all the way up here because of a 4-hour market structure shift? Right? Complete load of BS. I get angry at market structure because so many students message me and they would be profitable, but it's just market structure that holds them back. They get everything right, bias, liquidity sweep, entry, but for whatever reason, they're just obsessed with market structure, and it's not needed. Honestly, it's not needed. The moment I ditched it was the moment I became a profitable trader. Anyway, I'm ranting. What we want to do now is, we know we're bullish on the 4-hour chart too, is we really want to start looking for our entries. Now, for me as a swing trader, what I would look for, ideally, is for price to come up a bit more, make it very clear that we're going to take out all-time highs here, make it very obvious that we're going to take out these highs here, and then just enter on a retracement, right? That's what a swing trader would do. That's what I would do. Because I swing trade now because I'm too busy to day trade. That's what I would look for. And you don't go below the 4-hour chart. I see a lot of people, who go on the 1-hour chart, and they make the mistake of looking at the 1-hour chart trying to predict daily buys. You only need the weekly, daily, and the 4-hour chart. And again, you don't need the monthly chart. Like, you really don't. You can everything you need is on the weekly, daily, and 4-hour charts. The 1-hour chart and below, we're not doing any sort of higher time frame analysis. We're just looking for entries. We're looking for entries and targets, right? Very, very important, because so many people say to me, oh, hey Atif, this bullish order block didn't get respect in the 1-hour chart. We don't care about that. We're only looking for entries, right? We did the hard work was done on the higher time frames. We used the higher time frames for our direction, and we used the lower time frames for our entries. So here we are on the 1-hour chart. We've got this giant, probably a news candle. I think this is not. I'm not even sure what this was. We've got a giant bearish candle here. Again, a lot of people think this is a market structure shift. I mean, it's kind of hard to tell on the 1-hour chart because we've got this massive fair value gap here. Just mark it out all the way up here. Huge fair value gap. What I like just from looking at it is I like these order blocks up here. Right, now, price is not likely to respect. Let me just mark all these order blocks here. This whole area here is essentially order blocks. Now, price isn't likely to respect this order block at all. But what it is likely to do it's likely to trade up to it, right? So that gives us just a general target of where price is likely to go. But again, the 1 hour chart, it's not the best, right? It's not the best currently, because for me, this price action is not ideal, right? I want to see clearer, obvious liquidity or fair value gap, something that I can target. So at this point, I get onto the 15-minute chart, right? Like this. Let's just zoom out a bit again, right? So instantly my eyes are gravitating towards this fair value gap here, right? Because price does not like to leave fair value gaps up for long. So let me just make this a bit more clearer. Actually, if you are very eagle-eyed, you'll see a little gap between these two candles here. Now, I don't know if I might have mentioned this months ago, right, in one of my earliest videos, because this is very advanced. This little, let me just mark up this little gap here between this candle and this candle here, this little tiny gap. This is something called a volume imbalance. Now, there's a few people ask me like weird terms that they use to describe it. I call it a volume imbalance because I learned from ICT. If you call it something else, that's fine. I call it a volume imbalance personally. And what it is, it's just a gap between these two candles, and it acts as like a very strong version of a fair value gap. So, you know, I'm sure we all know this is the fair. Let me just mark this out again. Right? I'm not going to actually close this. So this is the fair value gap. Let me just do it. From here to here, this is a typical bearish fair value gap, right? Most people are aware of that, right? A fair value gap, you see it quite a lot in price action. You don't see this volume imbalance much, but this volume imbalance here is a very strong magnet for price action. It's almost like a very strong version of a fair value gap, right? Like a super fair value gap, if that makes sense. So price is extremely likely to at least touch this area. And what I mean by that is price is extremely likely to do something like this, right? So this could be a very good target. And remember, this is the 15-minute chart, right? So, you know, a little scalp or day trade up to this level and up to this fair value gap, that can get you, you know, a 3-to-1, 3K in a day. Like, you don't need, like, you don't have to target liquidity all the way up here. You just need a 2 or 3-to-1, 2 or 3 risk reward ratio in the overall direction of the market. That is all you need to be a profitable trader, right? So many people message me saying, hey, Atif, do I need to target all-time highs? No, you don't need to target all-time highs. You just need 2 or 3 risk reward ratio in the overall direction and a 50% win rate. That's all you need to be a profitable trader. That's all you need. And ignore anyone saying you need an 80% win rate or anything like that, right? You just need consistency. That's all you need to be a profitable trader. It's just consistency. So, right, and obviously, you know, at this point, you would use, you know, your liquidity sweep or whatever entry pattern you use. I'm not going to talk about entries in this video because there's so many videos on the channel where I give you entries. So make sure you go check them out if you're unsure about entries. But I just want to give you the overall direction of the market. And at this point, like, we've done the analysis, we know we're bullish, and we're just looking for targets. And for me, this is a clear intraday target. Let's just get on the 5-minute chart and look very quickly, see if we can see anything. Again, you know, you can look at this fair value. I don't want to talk too much about this, but again, always nice to see, right? A little tap of the fair value gap here. I guess, did we tap any order block here? We didn't tap this order block, but we did hit this fair value gap here. But again, you're really looking for your entries here, so you could enter on the fair value gap. You would just miss out on an order block here. You could enter on a fair value gap here. Doesn't really matter. Like I said, the entry pattern is the least important thing. I think price would probably hit this fair value gap too, just by looking at it. But again, at this point, you're just looking for your entries. You can get on the 1-minute chart, whatever time frame you want. This is your target, and this right here. Let me just move it out of the way. This is your obvious target. Price is likely to hit this too. Is it likely to take out these highs? Is it likely to take out these highs on the same day? Who knows? But the overall direction, the highest probability entries are going long. And at this point, you're just looking for your simple entry pattern. I want to show you something called like SMT diverge. I don't want to make it too complicated, but I want to show you how you can pick the best setups, right? Because if you're trading, let's say 2 pairs, you want to be trading the best setup on the day, right? So what you need for this is you need a very similar market. So gold and silver are very, very similar markets, right? And it's pretty self-explanatory. They're both very precious metals, very, very similar markets. We can compare these two markets. Same thing for, let me just get my watch list up. Same thing for the S&P and NASDAQ, right? Very, very, very similar markets. You can do the exact same thing I'm about to show you on, you know, these 2 pairs. You can also do it on Euro and GBP USD, right? You can do it on the exact same thing, but the markets have to be very, very similar. You can't use, you know, you can't do CAD JPY and the S&P 500, right? You can't use it on that because they're not related in any way, shape or form. But for gold, its sister pair is silver. And I want to show you why silver is not the best trade. So it's still bullish overall, but let's just talk about it. So this is the weekly chart for silver. This is the weekly chart for gold. So just pause the video, look at this weekly chart here. Right, just look at this weekly chart, study it, and then study this, right? You can probably tell gold is by far the most bullish, but why is that the case? Why is gold the most bullish? And what does this price action even mean here? So run the weekly chart. Let's just get back here. Silver right away, it's consolidating, which we never ever like to see. Gold is at all-time highs, very, very strong, minimal retracements, right? So see this huge bullish move. This is our little retracement. This was your retracement here, this little down close candle like that. Whereas silver, let's just study this bit here. Whereas for silver, where's the path tool? Silver, this is your move here, right? And we still haven't even taken out these highs here. We still have not taken out these highs here. That is not good at all. That's not what you want to see at all. And that tells us that we're nowhere near as bullish on silver as we are on gold. And this is something called S&T divergence, which means, it essentially means that this high here, price had taken this high, right? It had gone up and it had taken this high here. Whereas this high here, the equivalent high, had not been taken, which tells us that we're very, very, we're nowhere near as bullish right now. We still are bullish overall. And this is what a lot of people get confused with. This right here is your bullish order block. The price taps into it. I think it just about touches the body, shoots off, right? But do you notice how when we shoot off, we get loads of these doji candles, long wicks, small bodies, down close candles, not good at all, right? Very, very choppy. And you can just imagine if you were scalping this, just lots of, a little liquidity sweep, another liquidity sweep, slowly moves up, like just slowly grinding up, lots, very difficult to trade, taking out your stop loss, double liquidity sweeps, not good at all, eventually gets your take profit. If you are in a trade, it'll probably take you like 2-3 hours just to hit take profit. It's not good at all to trade. And you can just tell by looking at the weekly chart, with all these large doji candles, the fact that we've not taken out this high, that silver, is not ideal to trade. So we're just going to daily chart. And again, I'm doing this live, so I have no idea what price is actually looking like here. Again, so my eyes instantly see this candle here, the last up close candle before the down move, that's your bearish order block. Like that, right? You see how price, it's almost respecting it, isn't it? Right, we have these little doji candles in there, and now we're starting to, I guess, not reverse, but retrace. And what you really don't want to see, and I always say this to my students, this is like, you really don't want to see this in trading. We haven't touched this order block, we have touched this fair value gap. What that means is price is almost respecting both sides. And this is like the analysis of death. If you see this, you want to avoid this pair, or whatever pair this is, at all costs. And what that is price is respecting the bearish order block, and it's respecting these bullish fair value gaps, these bullish order blocks. So it's respecting both sides. And you never, ever, ever want to see that in price action, because if price is respecting both sides, what you're going to get is you're going to get this. You're going to get consolidation. It's going to respect some order block here. It's going to respect some bullish one here, a bearish fair value gap here. Just going to consolidate for ages. You're going to get a double liquidity sweep where it sweeps both sides, consolidates, does nothing for ages, comes out, comes up. You think it's going to go up, and it goes right back down. And it's just awful to trade. You do not want to trade that at all, right? So that is something that will save you so much money right there. If you see price respecting bullish fair value gaps and bearish fair value gaps on the daily, weekly, or 4-hour chart, avoid that pair. Just avoid the pair, find another currency, and your win rate will skyrocket massively, and you will avoid so many unnecessary losers, so many break-even trades, so many choppy trades. And yeah, anyway, I'm rambling on for quite a bit here. Let's just get quickly on the 4-hour chart. Let's just clean these charts up and get on the 4-hour chart and just see what we can see, right? Because I'm not going to get below the 4-hour chart for silver because it's not really needed. Again, my eyes instantly see this. This almost looks like a liquidity sweep to me. Just mark this out. See these almost triple lows here. Remember, this is the 4-hour chart, so this is very, very significant. Right? This isn't the 1-minute chart. This is a very significant time frame. See how price wicks down? It's not instantly reversed. Which, again, that's what you'd expect for a choppy pair. Hasn't touched the order block either. Again, not ideal. It's not even touched this bullish fair value gap. Not ideal at all. These wicks here, let me just show you. See these almost, what the fuck is this? See, there's like 4, triple, highs here are respecting this order block here, this bearish order block here, right? Look at that. Look at that. Beautiful, isn't it? Look at that. Tap, 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 tap. Moves down. This bearish fair value gap. Look at this. Also being respected. Almost like a liquidity sweep. price is like respecting all these order blocks, we're just going to consolidate in between, right? We're just going to consolidate in between, right? Like this. Just consolidate where you hit this again, come back down. Liquidity sweeps here, come all the way back up. Just messing around, and you do not want to trade that all. And what that really means, let's just zoom all the way out. What that really means for you as a trader, just clear all this. It means you want to avoid silver, don't trade it, don't look for shorts, because overall on the higher time frame, it is bullish, but it's slowly going to move up, right? It's going to slowly move up very lethargically like this, very lethargically and slow. You want to avoid silver, don't look for shorts, don't look for longs, just don't trade it. And what that really means is look for gold, look to trade gold, and only look for longs, because gold is in a bull market. It's easy. I mean, look at all these candlesticks here, how strong and aggressive it is. It's one-sided. You've got everything on your side. Higher time frame, liquidity sweeps, everything you could ever need. And you only want to be trading gold. And if you do the equivalent analysis on GBP USD and Euro USD, you'll see the exact same thing. I think off the top of my head, I think NASDAQ is essentially the equivalent of silver in this case, and gold is like the S&P 500, where NASDAQ has been very terrible and the S&P is very clean. So yeah, but you'd have to double check that, right? And that'll be a good like homework assignment, right? Go through the S&P 500, go through the NASDAQ, and just see what you think, right? But for top-down analysis, what you want to do, start off on the weekly, go to the daily, go to the 4-hour chart. Those 3 time frames, this is very important. Those 3 time frames give you your higher time frame direction, right? You've got your bias, your higher time frame bias on the weekly, daily, and 4-hour chart. You do not get your bias on the 1-hour chart or 15-minute chart or 5-minute chart. You only get it on the higher time frames. Once you've got your direction on the higher time frames, you get onto the lower time frames, right? The 1 hour, 15-minute, 5-minute, 1 minute, or even the 4-hour chart if you want to be a swing trader. And you look for your entries. Now, the entry I always say, and don't worry if you don't understand this, it's just a liquidity sweep. So let's say you're bullish, which we are on gold. And let's just suppose this is let's say the 5-minute chart, right? You want to see a price come, take out an old low, quickly shoot off, leave some sort of fair value gap here for you to enter, put your stop loss here, and then target a 2 or 3 risk reward ratio. And if you do that, and you get a 50% win rate, you will be a profitable trader. You will be a consistently profitable trader, right? All you need is a 2-to-1 and a 50% win rate to be a millionaire. And for those who don't know, if you're not following me on Twitter, you should do. But if you are, you'll remember I met this trader and he had a 45% win rate and he made 117k in a month, right? And I think his win rate was 2-to-1, that's 2.4 risk reward ratio, and he made 117 grand in a single month. And at that moment there, I was like, oh shit, I need to sort my life out, because I was obsessing over win rate. It's not needed. A 50% win rate and a 2 risk reward ratio can make you a millionaire. Congratulations if you got this far, because that was a very difficult pair to determine daily bias on. But if you understand that, congratulations. Now, I'm going to give you a bonus tip, like I said, which I normally give to my paid students. And yeah, this is a golden nugget, and it's the little things like this that make you profitable. People always ask me that, hey, what's the difference between YouTube and your paid program? It's the little. You probably understood it in this video, right? The little things that I mentioned. That's probably what clicks in your mind, right? It's probably not the liquidity sweep, fair value gap. It's probably the little analysis that when a price comes very close to an order block, but then shoots off. That's even more bullish, right? Little things like that is what makes you profitable. But anyway, I'm rambling on. What you can do, right, is let's suppose you're on the weekly chart and you're like, oh, okay, look, it's taking out liquidity here, it's respected the bearish fair value gap. I'm not really sure where price wants to go. What you can do is you can get the futures contract up, and we can look at the dollar index. So if we click the dollar index, remember, we're trading USDJPY. What does that really mean? It means the US dollar against the Japanese yen. Now you might think, well, where am I going with this? We are trading one currency against another. So there's a few things that can happen. If the dollar is bullish and the Japanese yen is bearish, price is going to go up. If Japanese yen is bullish and dollar's bearish, USDJPY is going to go down. Right? And if one is bullish, let's say dollar is very bullish and Japanese yen consolidates, dollar yen will go up. And similarly, if the dollar consolidates and JPY is very bullish, USDJPY will go down. Right? Hope that makes sense. That's what it really means. If we zoom out here, the overall trend is bullish. Now, if we look at the dollar index, this is the US dollar on the weekly chart. The overall trend on the dollar is bullish. Now, again, you might be confused, like, okay, how do I really know if it's bullish, right? Because because of this, order block. Price isn't really close to any liquidity pool. It's retracing quite a bit. It almost took out this low. How do I really know? This is the golden nugget here, right? Right here, if you type in US30Y on TradingView, you'll get something called the United States 30-year government bond yield. Now, it sounds complicated. All you need to know is this is the interest rate for the US government's debt, right? So, like bonds and stuff. This is the US government's interest rate. And this is something for your notes. The higher the interest rate, the more valuable the currency, right? So the higher the interest rate, the more valuable the currency is. And it makes sense, right? If you can get 4.673% investing in the US dollar compared to, let's just suppose, 2% in the UK. I know that's not actually true, but let's just imagine that was. If you're an investor, obviously you're going to invest in the US dollar, right? Now you might be wondering who's investing in dollars or currencies. Big banks, big hedge funds, pension companies, those who have money. Not us, but those who actually have, a shit ton of money, they're investing in currencies, right? And the only thing they're looking for is interest rates. So with a dollar, you've got a very, very good interest rate. And I don't want to get too much into macros, but if you probably understand that the Japanese, interest rates even negative or like zero, right? So it's not valuable at all. You don't need to know that. All we need to do is look at the price action. And if you look at this price action, I hope it's pretty obvious where price wants to go, right? Here's your here's liquidity. Here's your liquidity sweep there. Here's your respect of the order block. Let's mark this out. Here's respect of your order block there. Here's your liquidity pool up here. Right? Well, that's pretty obvious, right? Look, listen, it might not be obvious at first, but if you watch that full 2-hour trading course and you binge watch a lot of videos on my channel, this will become second nature, and I recommend that you do that. Just get it over and over and over again into your head, or your subconscious mind, for those who know. Those who know what I'm talking about will understand that. But here we go. So price comes, takes out liquidity here, comes up, little retracement, nothing major, not towards these order blocks. Again, comes up, makes it very clear that we're going to go for this high here, right? No order blocks being respected here, no bearish order block. Very clear that price wants to come to this high. Here's your retracement into an order block. What's price likely to do? Go up. What does that mean? What does this really mean as traders, right? Let's just remove this. If the US interest rate is going to go up, right? If it's likely to go bullish and it's going to take out this high, what does that mean? Interest rates are going up. What did I tell you? That means the dollar is likely to go up, right? Because it's higher interest rate, it's more valuable, right? Overall perspective for the dollar is bullish, right? We are bullish overall. So this right here is just a retracement before we continue up. Now you might be wondering, okay, that's cool, interesting. Why do I care about this? This is why we care about this. This is the dollar. This is what this index actually is. This is the US dollar against all the major currencies, right? So GBP, USD, yen, all that sort of stuff. This is the dollar against all the major currencies. If we scroll down, I mean, you don't have to scroll down. If you type in 6J on your charts, right? If you type in 6J into your TradingView charts, you'll get the Japanese yen futures. That is the exact same thing, but for the dollar, right? So this is all the currencies against the Japanese yen. Essentially, it's how valuable is the Japanese yen, right? Whereas this is how valuable is the dollar. This is the dollar against all the major currencies. This is the yen against all the major currencies. Now, you remember from school, spot the difference. If we look at the dollar index, right, just pause the video, take a screenshot. Just study this price action here. Right, let's just zoom out. Study this price action here. Study this price action here. What direction is this going in? Clearly bearish, right? What direction is this going in? Bullish, or at worst, consolidation. And do you remember what I said to you? If the dollar consolidates and the Japanese yen is bearish, what does that mean for USDJPY? It's going to go up. Right, remember what I said to you. So, at worst, this is going to consolidate, but we know by looking at the bonds that this is actually going to go up, that we're actually bullish. So if we get Japanese yen, and we just study the price action, I mean, for years and years, this drop was around 2021. We've been bearish, 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 and if we look at the price action, right here is your liquidity sweep. I mean, this stuff works, right? I'm not making this up. This stuff actually works. This is gold dust right here, which I'm giving you. This right here, this works. Liquidity sweep here, price comes all the way down, barely respects the order block. I know we do respect an order block all the way down here, but come on, guys, is that really respect? What's actually going on? Like we said, this is just a retracement here. Again, look at that. It's almost like I work for the central bank. Look at this. Here's the 50% level. Look at price. It hits it, wicks down, wicks down, wicks down, and now it's starting to reverse. This is just allowing smart money traders to start selling, 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 right? Selling, selling, selling. So what does this really mean? If Japanese yen is likely to do this, continue downwards, take out this low, like that, continue downwards, and dollar is likely to go up, like we said, because of the bond yields. Dollar's likely to go up and eventually take out this high. What does that mean for USDJPY? Right, what does that really mean? Let's get all the way down here. What does that really mean? It means we're likely to just we've really done our retracement already. It means we're likely to just do that, right? You guys understand that? And if you zoom out, you can see from the previous price action that I've shown you, that's exactly what happens, right? Remember, the yen was very bearish, the dollar was bullish or consolidating. What happened? USDJPY shut up. And again, this is around 2022, 2021 is when we start getting that big bullish movement on USDJPY. Exact same time when the yen starts to drop. So quick and easy. Oh no, I say quick and easy for a minute. It's a hard way, but once you get used to it, you can just mix and match currencies left and right. Because what you really want to do, and we're getting very advanced here, what you really want to do is you want to match strong currencies with weak currencies, right? So in this case, the Japanese yen is weak, dollar is bullish, right? So you've got strong currency against a weak currency, which is an easy trade. And let me give you another example, just a quick and easy trade. This is what I do over and over and over again. So if we get onto 6N, so this is the New Zealand dollar futures, right? This is, again, the New Zealand dollar against all the currencies. Right here's liquidity. Here's your liquidity sweep. Here's the obvious low that we're going for. Completely, you know, if you understand liquidity, you know we're definitely going for this low. And again, there's another low right here. No order book's being respected. We're choppy, we're consolidating. Remember this price action, right? Just close your eyes and make sure it's in your head. Now remember this, right? You see the difference. You see the complete difference between this. This is a lot more. This is pound futures, by the way. 6p. See how GBP, I shouldn't say GBP actually. See how the British pound futures are a lot more bullish than the New Zealand dollar futures, right? What does that mean? If we've got bearish and we've got bullish, what does that mean? It means GBP NZD is going to be bullish. So we get onto GBP NZD. Look at that. And you can see like my looking for an entry. Let's just remove this, right? Look at that. Almost like clockwork, isn't it? Almost like clockwork. Just by looking at the futures contract, you can play matchmaker, and we zoom out. There's liquidity on like the daily and stuff. I don't want to bore you guys, but this is what I do, and you can see literally what I do every single day. And as a day trader, you don't want to be trading any of these like exotic currencies and stuff. But if you're a swing trader, this is a gold mine. This is an absolute gold mine because you can just get into easy trades, right? I mean, it's obviously not the best here, but even here, you could probably take it. You could probably take this trade, and by this trade, I mean, you could probably take this trade and become have a winner more often than not, right? And this is a poor trade, like in terms of price action, because I mean, I don't want to get too much in depth, but GBP AUD is actually the better setup here, right? So this is the better setup. But anyway, I'm rambling on. That right there was a very golden nugget right there that I gave you. So if you didn't understand that, don't worry. All I'm really trying to tell you to do is if you're struggling with the let's just get out. If you're struggling with the bias, using the currency futures can help you break the deadlock, so to speak, right? So very important. And yeah, I love making these videos. I love making these long analysis videos. I used to do it every week. I don't know if anyone remembers. I used to do it every single week. I used to do the weekly analysis of Forex, but nobody cared. Nobody cared. There's only like 50 people who watched it. So yeah, this is what you need for daily bias. Look at liquidity first. Look at the fair value gaps. You can look at order blocks, you know, just study them. But make sure whatever happens on the weekly chart, you want to see the same thing happen on the daily and the same thing happen on the 4-hour chart. That's all you need for daily bias. Now, for those who don't know, liquidity is stop loss orders. They're the exact same thing. And these markets are only going to move for where the money's at, right? It's only going to move for where smart money, Goldman Sachs, big banks, hedge funds, central banks can get into and out of their position. So what I'm about to tell you here works on every single market imaginable. It doesn't matter whether you live in India and you trade the Indian stock market, it's going to work, right? If you can find it on TradingView, this will work because like I said, all markets move based off liquidity. If it's listed on an exchange, it moves based off liquidity. Even penny stocks for the person who was asking. So now that we've got out of the way, what you're going to do for whatever market you trade is you're going to get onto the 4-hour chart, right? And you're going to ask yourself this almost stupid question, but trust me, this works, right? So let's just imagine you're on the charts at this point right here. You're simply going to ask yourself this question. Is price most likely at this point here to continue upwards and take out this high here, where there would be lots of stop loss orders, lots of liquidity? Remember, support and resistance, people are going to put their stop loss there. is price most likely to do that? Or is it more likely that price is going to come all the way down here and take out this low here, or even this low here, right? Let's just remove this. Which one's more likely do you think to happen? Right, no one knows for sure. No one has 100% win rate, but what's more likely to happen? Is price more likely to go for this high, or this low, or this low? Right, hopefully, pretty obvious price wants to go for this high. Now, if you're ever struggling with liquidity and determining, which high or low to actually look at, simply use the indicator. It does it all for you. But like I said, right, the indicator will add to the win rate. But again, you can become profitable using this with just naked charts. But essentially, which high or which low is price most likely to go for? Very, very unlikely that price is going to come all the way down here and take out this liquidity. Very likely that price is going to go for this liquidity here, which is a 4-hour high and a daily high, right? Buy side liquidity. Again, terminology does not matter, right? All we need to know is that price is most likely to go for this high here, right? All you need for liquidity, right? And the reason why liquidity is so important is it gives you your bias, right? And you need a bias to trade. If you've got the bias right, you're 90% of the way there. So all you're going to do is get onto the charts and ask yourself which major high or low is price likely to go for, right? We're not guessing, hey, is it this low? Is it this low? This high or this low? Which one's more likely? Is price more likely to just continue upwards and take out liquidity here? Or is price more likely at this point all the way up here, come all the way down and take out this low, right? Might sound like a stupid question, but hopefully very obvious, right? What price wants to do. Price is going to smash through these highs, which is actually all-time highs on the S&P. Now, what does price do after this? Does it reverse? Does it continue upwards? Does it consolidate? Who knows? But more importantly, we do not care. We can make money riding price up and targeting these highs. And someone was asking me like, hey, Atif, do we enter once liquidity has been taken? No, we do not, right? Liquidity is only used for the bias, for the direction of the market. So we have our liquidity, we have our daily bias, whatever you want to call it. We are bullish, right? That's the key takeaway from this, I don't know however long this was, 2 minutes, is we are bullish, right? We are bullish and we're only going to look for longs on the lower time frame. Okay, so the first thing you're going to do for whatever market you trade, because this will work on every single market that you can find on TradingView or on your prop firm, any market whatsoever, is you're going to get onto the 4-hour chart, right? And you're simply going to ask yourself this question, which might sound stupid, but trust me, this actually works. Is you're going to go onto the 4-hour chart, and whatever point you are in price action, you're going to ask yourself which high or low is price most likely to go for, right? And that might sound like a stupid question, but I'm telling you, the only reason these markets move is for liquidity, and liquidity is simply major highs and major lows where there's lots of stop loss orders, right? So if you don't have a direction, a likely direction for the market, and you're buying and selling, you are gambling. Now that might sound harsh, but you need to have a bias, and the easiest way to get your bias is to get on the 4-hour chart for whatever market you trade and essentially just ask yourself at the at live price action where we are right now, which major high or low is price most likely to go for, right? So at this point right here, right, this is market open, see this green thing here, at this point right here in live price action when you're on the chart, is price most likely to go for this low? So we've got this low and this low, these equal lows. Or is price most likely, more likely to go for some sort of high all the way up here, right? I don't even know where the most obvious high would be. Hopefully, it's pretty obvious, and I have marked it out, and I always tend to do this. It's pretty obvious that price wants to go for this low and this low here, right? Where there's relatively equal lows, and more importantly, there's lots of liquidity, there's lots of stop loss orders, because the only reason these markets move is for liquidity, right? And liquidity and stop loss orders are the exact same thing, right? And the reason the markets move for liquidity is because this is where all the money's at, right? Smart money, those with billions, they can't just randomly market buy like me and you can on the 1-minute chart, right? If you've got $5 billion that you want to get into the market, you're only going to do it where there's major stop loss orders, right? Where there's also billions of dollars worth of money resting here. And on GBP USD and any market, you're going to find that on the 4-hour, daily, and weekly. But the 4-hour chart tells you everything that you need to know. So we know, right? We know it's very likely that price is going to come down and take out these lows here, right? This low and this low here. Right away, we have our bias. I don't know how long the video's been currently, maybe a minute long. Within a minute, we have our bias, right? No complicated daily bias, or top-down analysis, or weekly chart. This is the easiest way to get your bias for the market, right? And for those who don't know, bias is simply the direction, right? The highest probability entries are going to be targeting these lows, right? So when we get onto our lower time frames, we're only going to look for shorts. A liquidity sweep is simply a stop run. It's a fake move in the opposite direction of the market designed purely to take out stop loss orders. And you will see this in every single market, in every single session, because the highest probability trades always occur after a liquidity sweep. So what actually is a sweep? So can you see this bit of price action right here? So we've got this point here, which is essentially end of Asia, beginning of London's low. Price shoots off massively. Now, when it shoots off massively, lots of people are going to start putting their stop loss orders at this low here because they're going to think it's very nice and safe because it's a major sessions low. And then can you see, this is really important here, can you see how price consolidates or accumulates for a bit? You might hear ICT say accumulate. And then look at this point here, right? Where does price go here? It drops massively, but it doesn't drop to any random point. It drops all the way down just below this low here where there's lots of liquidity, instantly shoots off in the opposite direction, gives smart money traders their entry, and then goes in the opposite direction, taking out liquidity. And you will see this over and over and over again in every single market. And it's insane how high probability this setup is. And the reason why it's so high probability is because liquidity is taken out at this low here, right? So this fake move here, right here, is a stop run. It takes out stop loss orders. So any entry after a stop run, after stops have been raided, is super high probability. Okay, so how do we actually make money with liquidity sweeps? What do we actually look for? So if we just explain this in more detail, this right here is the fake move, right? This is a fake move which causes our liquidity sweep. So this blue line here, this dark blue line, this is where the old low is, right? So this is Asia and London's low. Lots of liquidity at this major low here because price shut off. Lots of people think that this low is nice and safe. Price at this point here, so this is Dow, right? So this is indices. So at 9:30 a.m. open, our fake move starts, right? So you'll always find this with indices. At 9:30 a.m., there will always be a fake move. Now, if you trade Forex at 8:30 a.m., whenever there's news release, there will always be a fake move. So if you want to trade news on Forex, this exact same thing will apply, right? So the moment the indices open or the news announcement, there will always be a fake move designed to take out liquidity, right? It will always be a liquidity sweep. So price instantly at 9:30 a.m. drops, takes out this low here, right? Takes out this low here. So this light blue line, or this dark blue line is the low. It takes out the low and then instantly shoots off in the opposite direction. Now this is really, really important here, so pay attention, right? So once we go below this dark blue line, right? I don't know it's a liquidity sweep, right? I have no idea whether price wants to just continue to drop massively or whether it's going to start to reverse. I have no idea, so I need to wait for confirmation. Now, there are traders who don't wait for any confirmation. They just buy as soon as price goes below an old low. That's referred to as turtle soup. So you might hear traders talk about that. That's what that really is. I don't trade that. I always wait for confirmation. And the easiest way to wait for confirmation is to wait for a fair value gap to form in the opposite direction of the liquidity sweep. So the moment this bullish fair value gap forms in the opposite direction of this sweep, right? Because remember, this is a fake move, takes out the low. So the moment this bullish fair value gap forms like this is smart money screaming at us that this really is a liquidity sweep. This is really just a fake move designed to take out stop loss orders. That's the only reason price came all the way down to this low and then instantly reverses. It didn't go down to some random point. It only came down to this low here.
Okay, so we're in the lower time frames, and most people understand what I just said in the higher time frames. They know we're bearish, but they always go wrong in the lower time frames. Now, why did they go wrong? Because they're not waiting for a liquidity sweep. Now, what is a liquidity sweep? And a liquidity sweep is, a liquidity run, liquidity graph, whatever you want to call it. It's the exact same thing. What it is we know we're bearish on the higher time frames. We've done the hard work, which is always on the higher time frames. We know the actual direction of the market, and we're looking for any reason to get short. Now, we're waiting for some sort of key high to be taken out because we're bearish. Now, why are we waiting for that? We know, right, and you've probably had this loads of times where you might have shorted here, right? You might have shorted at this order block, let's say. So this order block, the last up close candle follow down move, you might have put your entry right at this body here. You would have had your stop loss maybe up here, and you would have targeted maybe this wicks low, like a 3 to 1 or something, right? How many times have you had the bias right, the direction right, but price literally will come down, go straight through to your stop loss, take out your stop loss right here, and then quickly reverse? Like, how many times that happened? Because that used to happen to me all the time for years. Like, I would get the bias right. I knew exactly where it was going to go. Price would come, it would literally wick up, take out my stop loss, instantly reverse. The reason why that happens is because you're not waiting for a liquidity sweep. Now, what is a liquidity sweep? We know at this high here, there's lots of stop loss orders here. Lots of people have gone short on gold. They know from the higher time frames that we're bearish. So they've got the stop loss orders here. And I'm going to mark this out, right? Because this is so important. When price comes all the way like that, right? See this wick here? See this wick? So let me make this more obvious. See this wick? You see how it points up? Literally comes out, takes out this high. Let me make this a bit more clearer. Right, comes up, takes out this high, instantly reverses. Look how aggressively we reverse. That right there is your liquidity sweep. Right, it pokes up, takes out the high, quickly reverses. That is your liquidity sweep. And this is really important. We don't know it's a liquidity sweep until around down here, right? Because once the wick comes and takes out the high, you know, it is possible the price could have had a little retracement and continued up, right? But when we see a wick that just points up, just takes out that high, and then quickly reverses sharply, that right there tells you you've got a liquidity sweep, right? And what we really want to do is we want to enter on that retracement after the liquidity sweep. So I'm just going to mark out the liquidity sweep here, because you always, and this is so important, if you're a day trader, scalper, or even a swing trader like I am, you want to wait for a liquidity sweep before you enter, because if you don't wait for a liquidity sweep, you're going to get swept. So I'm going to mark this out, liquidity sweep. Right, and this is probably the second most important thing. Once you've got the bias, you need to wait for a liquidity sweep. Otherwise, you know, you're going to be getting your stop loss taken. You're going to be right with the bias, and then you're going to lose, and then you're going to get angry. You're going to revenge trade, and you're going to keep losing and blow your account. All these things happen to all traders, and I don't want you to go through that. So we wait for the liquidity sweep, wait for the wick to take out the high.
Okay, so here we are on the 5-minute chart, right? And let's just imagine you want to trade the 5-minute or even the 1-minute chart, because I'm going to show you the entry on the 1-minute chart. Now, here's that big daily liquidity, that 4-hour high that we were talking about, all the way over there in price action, right? What we just talked about. Now, remember, our bias is bullish, right? Price is likely, very likely to go towards this high. Like we said, very unlikely it's going to go all the way down for that low. However, just because we're bullish, we cannot simply just buy the dip on a fair value gap and ride price up. If trading was that simple, I wish it was. If it was, we would all be millionaires, but that's not the case, right? Instead, we need to wait for something called a liquidity sweep. Now, if you don't know what a sweep is, go look at this picture on screen now, which explains it. It's probably the hardest thing in trading. Like, I'll be honest with you, it's probably the hardest thing in trading. It took me years and years and years to actually fully understand it. And essentially what it is when you're bullish, which we are, right? Remember, bias is always number one. That's why the 3-step formula is bias, sweep, entry. Bias is always number one. Now that we're bullish, what a bullish liquidity sweep looks like is this. Price goes up, it goes down just below an old low. It doesn't go massively all the way down here. It goes just below an old low. It quickly shoots off in the opposite direction. It does not need to be a market structure shift. So price could, let me just make this clear, price could be down here or down here. And then what happens is price will come down and give smart money traders a high probability entry and ride right off. The price will shoot right off towards the liquidity target, right? Now this is why, let's imagine you enter on a fair value gap here and it fails, but then another fair value gap works, right? This is why some fair value gaps and order blocks fail, others work, because you don't wait for a liquidity sweep. We need to be waiting for a sweep, which is simply a stop run, right? We need to wait for stop runs to be raided, purged, grabbed, whatever you want to call it. We need to wait for a stop run before we enter, because this gives us the highest probability setup in all of trading, right? There's nothing more, there's nothing that has a better win rate than this, because this is actually rooted on logic, right? Real logic on how these markets move. So, and the whole point of waiting for a sweep is so we know we can enter in a high probability trade, we can put our stop at a very, very safe area, and then we can target liquidity, right? That's the whole point, right? If we put our stop here on a fair value gap and we're bullish, and we want to buy the dip, price will come, take out our stop loss, and go straight to take profit. So that's what a liquidity sweep essentially is. Now, this is a fairly difficult example. Let me just remove this. And I always like to give you difficult examples, because if you can understand difficult examples, you will understand easy examples. And when easy examples come, you'll make a lot of money very, very quickly. So here we are in price action. Can you see any sort of liquidity sweep around here? Can you see any sort of low that gets taken and price quickly shoots off? Now, there's not really a retracement here, which is why I'm going to go into the 1-minute chart and show you it. But if you look at this bit of price action here, now I know it's messy, but again, like I said, it's a difficult example. So if we look at this price action here, let's just remove the indicator and let's just turn this off. I want to show you how to do it in like just naked charts, right? So if you don't have the indicator, this is how you would do it. Let's make this clearer too. You see our price? Now remember, most important thing is we are bullish, right? If we were not bullish, right now we'd be gambling. We have no idea what price is likely to do next. But because we're bullish, and we know we're targeting that major high on the 4-hour chart, this is why this works. So we have this low here, price goes up, just takes out this low, only slightly, and then quickly shoots off in the opposite direction. That right there is our sweep. We have our buyers. We need to get on to step 2 of the process, which is a sweep, right? Bias, sweep, entry. Now to do this, we're going to get onto your entry time frame, which is really important. So let's imagine we like to trade the 5-minute chart. What we're going to do now is we're going to look for a sweep. So right, this blue line here is the 4-hour liquidity that we were just talking about, right? Now what we want to see, right, it's not good enough to just enter blindly, right? You know, what is it? Buy low, sell high, buy low. It's not good enough to just do this, right? And if you've been trading for any length of time, you know this is not what happens, right? Trading is not that easy, right? Trading is not that easy. What usually tends to happen, and this is probably happened to you before, right? Is let's imagine we've got some high, price goes just above this high, enough to take out your stop loss, then goes up in the opposite direction, then gives all these traders here a high probability retracement. So let's say a fair value gap, order block, and then drops off in the real move. What's actually happened there is something called a liquidity sweep or a stop run, right? And this right here is like the golden framework that you'll see in every single market on any time frame. It is the highest probability setup in trading by far. Now, can you see this anywhere in price action here? Now, this is a fairly difficult example. So if you can get this, in any like market, right, whatsoever. So can you see this anywhere in price action? Let's move this down, right? Can you see some sort of high that gets swept, price drops, gives you a retracement, and then drops again? Can you see that anywhere in price action? Right, if you can, congratulations. So study this high here, right? Can you see how we just go above this high here, right? We just go above it, we instantly drop, and then we have our retracement and price drops again, right? So can you see this high here? Price just goes above it, just wicks above it, goes down, gives you your retracement, and then drops. Right, very similar to this framework here. So let's clean these charts up, and I'll explain this in a bit more detail. So remember, step 1 was the buyers with this blue line. Step 2 is our sweep. Right now, a sweep is simply a stop run, a liquidity sweep, whatever you want to call it. It's a fake move that takes out stop loss orders, allowing smart money traders to get into their position, right? Because these markets are highly manipulated and they only move for one thing, which is liquidity, where the money's at, right? And it's nothing personal against me or you. If you're on the right side of the market, you can make all the money in the world. You can make $1 million a month and it would be nothing to smart money because they are making billions in a day, right? And you know, if you're on the wrong side of the market, if you're stopped here, you're going to get punished, right? Simple as that. So,
you know, this isn't a video about entries. We've got loads of, you know, entry videos on the channel and stuff, but there's a fair value gap here, right? Easy fair value gap entry that you can take, right? So you put your entry right here. To make this a bit more obvious, put your stop loss at liquidity sweep high. Now, why do we do this? We talk about this all the time. Why do we do this? Because it's very unlikely if we're bearish and we've had this liquidity sweep, right? Because remember, price only came up here just to take out that high. That's the only reason it came up there, was just to take out that high. Very unlikely that price is going to come down all the way down here, come up, take out this wick again, and then go back down. Very unlikely. It is possible. It does. The lower the time frame you go, so if you're on the 1 minute, and especially on indices, you'll see that a lot. It's like a double liquidity sweep. But you know, for Forex, if you're on the 5 minute chart, very unlikely, right? Because price only came up here just to take out those stop loss orders. That's the only reason it went up there. It didn't go there for any other reason apart from just to wick up, take out those stop loss orders, so smart money could take the other side and ride price down. So it's super unlikely price is going to come all the way up, take out your stop loss, and then reverse. So it's very safe to put your stop loss here. Very safe, right? Very unlikely that price is going to come up. And in terms of take profit, always target at least a 2-to-1. And for me, I say never more than a 3-to-1. Now, why do I say that? Because let's just at least target this low, right? Because lots of liquidity, and you ideally want to be targeting the opposing liquidity pool. Now, what does that mean? It means if you're bearish, you want to target the opposing low. And if you're bullish, I target some opposing high. Really doesn't matter. But for me, a 2 to 3-to-1 is absolutely fine. And if we target this low here, basically get a 3-to-1. Now, why do I say never to trade and never target more than a, you know, free risk reward for day trading and scalping, and even swing trading, really? Because look at this. Let's say you target a 4-to-1, right? You did everything right. You got the buyers right in the higher time frames. You wait for liquidity sweep here, right? You wait for liquidity sweep. Perfect entry. Price comes all the way down, right? So it comes like that. You enter right here. Perfect entry. 3% up in profit, and it just chops like that. And then this is the end of the week, right? So it gaps up, or it just reverses on you, right? Imagine that. Imagine how annoying that is. I'm telling you, all you need is a 2 to 3 to 1 consistently. Right? I have a 50% win rate and a free risk reward ratio. I'm profitable. I can make all the money in the world. 10k a month, 100k a month. You know, $1 million a month maybe if I get enough capital. Like, I can make whatever amount I want, right? That's all you need. Most profitable traders have a 50% win rate and a 2 or 3 risk reward ratio. You know, all these guys saying you need, you know, a really tight stop loss, massive risk reward. You know, it's a load of crap. It's a load of crap. And that's because they have a tiny win rate. If you do this, you're going to get a good win rate. And yeah, always be realistic. Aim for a 2 to 3 to 1. And I'm going to give you another example on gold too. Okay, so here's another example in gold. And this is such an important example because someone was asking me, right? And let me just make this clear, right? So right here, let me mark this out. Right here is your liquidity, and here is your liquidity sweep. Price pumps up, quickly moves down. Now, someone was asking me, let me mark this out. Someone was asking me, does a liquidity sweep or run or grab, does that always have to be a wick? Right? Does it always have to be a wick that just points up, like we had in the last example, and quickly reverse? No, it can be a body as long as it aggressively reverses, right? Now, what does that mean? Right, look at this, right? So price literally pokes up. I know we get a body, and then it quickly and aggressively moves down, right? And then moves up and like that, right? You get big fair value gaps in the opposite direction. And when you see that, when you see price pumps up and aggressively moves in the other direction, and it leaves lots of fair value gaps, that tells you it was a liquidity sweep. Right? It was a fake move. The only reason price went up here was just to take out these relative equal highs for easy liquidity, and then quickly reversed. And we're not talking about in this video, but if you're more eagle-eyed, you'll see this low here. Once these candles close below that low, that's a market structure shift. Now, I'm not a big believer in market structure. I think liquidity is way more important, but some people do look at that. But what this is, this candle here, and you've got to understand, the overall thing. Because remember, we did all the hard work on the higher time frames. We know we're bearish. We know the key liquidity is at that key daily low, right? We're bearish and we're only looking for shorts, right? So we're operating on the lens of we're only looking for shorts. And this candle up here is just a fake little move. And I know you get a bit of a body. It's a fake move, but you would wait for these candles. Once you're all the way down here, right? So you're on the charts and you see this right here. Clearly, you're bearish, right? Clearly, this was a fake move, and we strongly, aggressively moved down. We've got relative equal lows here. Nice and easy trade. And yeah, for your entry, you can either take the order block, which would be this candle here, which you just about get, right, like this. Just about get, like that. Stop loss always at liquidity sweep high. Like we keep saying, I'm going to keep saying this until you're all bloody profitable. Very unlikely that price is going to come up, take out this high again, and reverse, right? Now, it can happen. It does happen rarely, but that's why you have your stop loss, but it's very unlikely. And for take profit, you can target this low for an easy scalp. Easy scalp. Don't do anything crazy, right? Don't do anything crazy, but just target a 3 to 1. Now, usually, if you want to take the fair value gap, right here, yeah, your stop loss is going to be wider, and you wouldn't get a 3 to 1, I don't think, right, in this case, and you wouldn't get this low either. But you can get a really easy high probability 2 to 1. Really easy high probability 2 to 1. And, personally, if you've done all the hard work, you've done all the analysis, I would just take the easiest entry. And fair value gaps often tend to be the easiest entry possible. But yeah, that is how you use liquidity to actually trade. You use it on the higher time frames, daily and the 4 hour. Find the direction that market actually wants to go to. You go onto the lower time frames and you only trade in that direction. You wait for a liquidity sweep and then you enter on that direction. And yeah, I'm going to give you more examples until you guys understand this. Okay, so we're on euro dollar, and like we did in the last example, what we're going to do is we're going to look for the key liquidity pool, right? And in this direction, or in this trade, sorry, we've been bearish, huge aggressive moves on euro. We took out this low, this low, this low. All of these lows here had key liquidity at it. Key liquidity at it. And at this point in the chart, so we're going to look for the most obvious key next liquidity pool. And if you look here, it's our next obvious liquidity pool, right? Lots of lows here on the daily chart on euro. There are billions and billions and billions worth of stop loss orders here. And the market will only move for those sort of orders, right? So we're bearish. We've got key obvious low we're going to go for. And we're going to look to short, right? Let me make this a bit more obvious. So we've got this key daily low. We're going to look to short, right, all these little opportunities we get at the lower time frames until price takes out this low. And once it takes out this low, it might consolidate like this, or it could even start to reverse, right? So we'll just wait for a few days. But as far as we're concerned, as long as this low is valid, we're just looking for shorts, and we just want to ride the higher time frame trend. And when we get the lower time frames, we're only going to look for shorts, and we're going to wait for a liquidity sweep. Okay, so here we are on euro. We've got like key daily low. We've got London's low as well. So we've got lots of liquidity and this key liquidity pool down here, right? And we're just looking for any reason to get short, And we're looking for our liquidity sweep. Now, Right, this move right here is a fake move. It's a fake move. Now, why is it a fake move? Because we did all the work on the higher time frames, right? We know we're bearish. We know the direction of the market. This right here is a fake move, right? We're not looking to buy this fair value gap here. Although lots of traders who only know about fair value gap, they know nothing about liquidity. They don't do any higher time frame analysis. They're looking to buy price here, and they're hoping the price goes up and it comes straight down, takes out their stop loss, and then they're angry, right? But you know, because we did all the hard work on the higher time frames, we're not looking for that. We're looking for short. We're looking for any reason to get short, and we're looking for a liquidity sweep. Now, this is a fake move up, and we get this high here, right? And we get these candles here that point above this high. That right there is your liquidity sweep, right? Price consolidates for a bit and then aggressively drops, right? And let me just make something clear. We only know that it's a liquidity sweep around here, right? Because price just came up, took out that high, and then quickly and aggressively and sharply shot the other direction. At this point here, once it wicks up there, I'm not thinking, oh, this is a liquidity sweep. I don't know, right, until it starts dropping aggressively, right? Because what we see here is just some consolidation here, and then once it aggressively drops down, then I know it's a liquidity sweep, right? I don't know it's a liquidity sweep until price actually shows me, until smart money actually show their hand that price wants to move down. And then again, we get fair value gaps and fair value gaps. So right here is your liquidity sweep. So let's mark this out. Right, so we've had our liquidity sweep like this, right? Aggressive move down, sharp aggressive move down. We've got our big fair value gap here. You've got an order block. The entry does not matter. And let me tell you something. The entry pattern is the least important thing. Right? If you've got the direction, right, like we've done on the higher time frames, you've got liquidity sweep. Entry pattern is the least important thing. Optimal trade entry, fair value gap, order blocks, breaker blocks, mitigation block, whatever you want to call it, whatever you want to use, all of them will work. So, yeah, in this channel, we just use the fair value gap because it's easy. You can use the order block, you can use any of it. Yeah, so you put your stop loss right here, liquidity sweep. Like we always say, very, very, very unlikely that price come all. Think about it, price come all the way down here, right? Very unlikely it's going to come all the way up, take out your stop loss, and then go straight back down, right? Especially when you're a day trader, because there's such a small time for price to actually move, right? So we've got a nice, safe stop loss. And what we're going to do is we're going to target the opposing liquidity, which is here, right? Easy liquidity right here. And you've got relative equal highs, right? So what risk to reward does that give us? Right, 2 to 1, or about 2.7. Just about get a free risk to reward ratio. But again, this is why I'm a big believer and you don't target anything more than 3 to 1. Because you might say, oh, well, it's all the way at this low. But okay, you get a 4.5 risk to reward ratio, but you've got to hold, for hours and through all the way up until Asia, really, which you don't want to be doing. Just take an easy, easy low-hanging fruit. 2 to 3 risk to reward ratio is all you need. With a 50% win rate, a liquidity sweep, higher time frame bias, you'll be fine. You'll be fine. And yeah, I'm going to give you another example. This time it's going to be in yen. Okay, so we're on dollar yen, and as always, we're on a daily chart, and you can do the exact same analysis on the 4-hour chart, but I'm just going to do it on a daily chart because it's nice and easy. And we've got this key high here, right? This key liquidity pool right here that price wants to go for. We're bullish. It's very obvious. We're respecting, these order blocks, these fair value gaps. It's all getting respected. Right? There's lots of liquidity at this high, and we know a price only goes for highs and lows. So all it does, it moves for highs and lows on the higher time frame. So we know we're bullish. We know we're targeting this key high, and when we get the lower time frames, we're only going to look for longs in dollar yen, and we're going to wait for a liquidity sweep, and then we're going to enter after a liquidity sweep. And it's really that easy. Okay, so we're running the 5 minute for dollar yen, and this is a London example because I want to show you it works in all time frames, right? It works, in every market and all time frames. And right here is your liquidity sweep. So let's mark this out. Right here is your liquidity sweep, right? And like we said, it doesn't always have to be a wick, right? It doesn't always have to be a wick, because right here is our liquidity sweep, and we get these little candles. You see how price comes in? You get these little tiny candles right here, and the price quickly shoots off. This right here is what some people will call accumulation, right? I don't want to make this video too complicated, but what that really means is that price right here, and because it's at a dead time. Now, what do I mean by dead time? 1:30 a.m. New York time is, Asia's ended, but London hasn't quite begun. London begins around 2 a.m., right? 2 a.m., which is around here, is when London actually begins. And 1 a.m., 1:30 a.m. Because I'm in the UK, right? This is around like 6 a.m., 6:30 a.m. No one's really awake or trading at this time. So this is dead time. So price will wait, it will consolidate, it will accumulate orders, and then it will start moving during the actual session in London, right? This is Asia, and then you got London here, right? So this is why you get these little tiny candles. But this is your liquidity sweep, right? We had liquidity here. I remember we had this big move up. We're bullish on the higher time frames. And again, right here, this is another liquidity sweep, right? You see this low? See how it wicks down, instantly reverses. That's your liquidity sweep there. Right, that low, price comes down, wicks down, instantly reverses. That's the liquidity sweep. But in this case too, right? The only reason price came down here was just to take out this low and then quickly, sharply, aggressively moves in the other direction. That's it. That's the only reason it does that, right? So that's your liquidity sweep. And it can be bodies, it can be wicks, but ideally it's about small little candles if it's a body, and then it quickly reverses. That's the key thing, right? If we don't see these aggressive fair value gaps in the opposite direction, then we're not bothered. But because we see these aggressive move in the other direction, we've got the higher time frame and bias, we've got all that in our favor. That makes it a liquidity sweep. And in terms of entry, we're just going to take this fair value gap here, a nice easy entry for you. So you're going to put your entry, this fair value gap here, stop loss at this low, because like we keep saying, if prices really come up, very unlikely it's going to come down, take out your stop loss, and then go straight back up. Very unlikely, because we waited for liquidity sweep. And the key thing is, you're going to have the patience to actually wait for liquidity sweep, because if you don't wait for liquidity sweep, you're going to get swept. Price, you're going to do, you're going to get the bias absolutely right, like I used to all the time, but you're going to be impatient. You're not going to wait for liquidity sweep. Price is going to come down. You're going to be the one that actually got swept. It's going to go back up, give everyone else a chance to actually get in at a fair value gap here, and go straight to your take profit. And you're going to be dead angry, and you're probably going to chase this move all the way up here. And as soon as you chase it, how many times has this happened? As soon as you buy it, like right here, it reverses like that. And you're blowing your account and stuff, And you always want to wait for liquidity sweep, because that will avoid all this hassle, man. Let's just remove all this, make the charts nice and clean. So in terms of take profit, you've got this key daily high right here. You've got key liquidity here. Let's target at least 2 to 1, and in this case, you get a free risk to reward ratio, just like that, right? If you really wanted to, you could target a 3.2, but it doesn't matter, right? I like a fixed risk to reward ratio, because for me, I always target a 3 to 1. 3 to 1, nice and easy, high probability sell, done and dusted. And yeah, I'm going to give you another example, this time in GBP USD. Okay, so we're on GBP USD, and I hope at this point, it's starting to get familiar, right? You're starting to get familiar with what we're actually doing. We're on the higher time frames, and we always do this, daily or the 4 hour. You can do the weekly, but you can see the weekly chart on the daily chart, right? This low here, you could also see it on the weekly chart, and this low too, right? So it doesn't really matter. I would say the daily or 4 hour, because the weekly is very slow, especially if you're a day trader or scalper. But nevertheless, for the daily chart, we've got this key low here, lots of liquidity here. We had another key low here that price took out, but this key low here, there's lots of liquidity here, and we know we're bearish. There's been no respect of this order block, and no respect of this order block. So let's mark out this candle just in case you are unsure. The last down close candle here, before the opening, that's your order block, right? Just make this a bit more obvious like that. That's your order block. Price comes in, aggressively, literally closes into the order block and wicks deep within it. There's been no respect of the order block, because if price actually respected the order block, it would have come in, tapped it, instantly reversed off. We don't get any of that. We don't get any of that at all. That right there tells you that we're bearish. We're bearish, and we've got this key liquidity pool, liquidity low, whatever you want to call it, right here. We know there's lots of stop loss orders, and we know we're bearish. So we're going to get the lower time frames, as always, wait for a liquidity sweep, and then we're going to wait for our entry. That simple. Right, so we're on the 5-minute chart now, and we're looking for our liquidity sweep. I hope it's pretty obvious. We got this key high here, and you've also got this high here, these highs here, but let's just go for this high, right? It's pretty obvious, and let's just mark this out. This high here, lots of liquidity out here, so let's mark this out right here, and this is your liquidity sweep. This candle moves up, wicks through it, and then we get a bit of a body, and aggressively, sharply moves all the way down, taking out all this liquidity, and then leaves this daily low intact, right? Leaves the daily low intact. So this right here is your liquidity sweep, right? And you're going to wait for this, and this is in London, sorry, this is in New York, right? The liquidity sweep. So let's mark this out. Liquidity sweep, like this, right? So this is your liquidity sweep. Fuck's sake, if I can actually spell, this is your liquidity sweep right here, like that, right? Price aggressively moves down, and this is during New York, right? So New York is a New York news candle. So you often get this during news, a fake move up, because remember, on the higher time frame, we're bearish. We've done all the work on the higher time frames. We know where price actually wants to go. This is just a fake pump up during news, and we come up, we wick out, take out this high, quickly move down, and as always, because we're bearish, we've had our liquidity sweep, wait for price to move down, enter on the retracement, like that. That's what we always do. That's the highest probability trade. And yeah, in terms of entry, you've got a tiny little fair value gap here, but I know some of you really like order blocks. So order blocks in this case is just the last up close candle before the down move. And let me just tell you something about order blocks. If you've got an order block, that's also a liquidity sweep that we have here, and it has a fair value gap, like it does here. And I know we've got a lot of wicks, but if you've got an order block that has a liquidity sweep, has a fair value gap attached to it, that right there is a very, very high probability order block. And yeah, let's just let's put my entry here, right? So we're going to enter at the order block right here, stop loss at the liquidity sweep high. And I'm going to keep saying this because people always ask me this. very unlikely price to come all the way up, take you out, and go straight down, right? The market is not designed to, take your stop loss out. It's designed to take out those with billions out, right? Not you personally, those with billions. So we can enter at this order block like that. So for take profit, we're going to target at least 2 to 1, or in this case, nice, easy 2.3 risk to reward ratio. I know you get your 3 to 1 like that, but at most, you're going to be targeting a 3 to 1. Like that, nice and easy, and this is how you actually trade with liquidity. You wait for liquidity on the higher time frame, so you wait for it to be obvious what daily high or what daily low we're going to go for. You only trade in that direction on lower time frames. You always wait for liquidity sweep, wait for a fair value gap, or any sort of entry, order block, optimal trade entry again. So for those who don't know, let me just mark this out very quickly. The optimal trade entry is you get your Fibonacci tool, because we're bearish, we do it from the high here all the way to the low, and me personally, I enter the 0.705 level, right? You get in your Fibonacci settings like this, like it. Pause the video. This right here is what you really need, 0.705 level. And yeah, take a screenshot of all these, because this is what I use personally. And yeah, for entry, enter right here. And the reason why I love the optimal trade entry so much is you don't have to think about what fair value gap, what order block do I take, right? It's so easy and obvious. And for me, I always target 3 to 1, right, like that, right? Like this, nice, easy, high probability trade. And I do this on the 4 hour. Literally, this is exactly what I do on the 4 hour. I wait for a liquidity sweep, optimal trade entry, obvious liquidity, and because it's a 4 hour, this liquidity is always significant and it's nice and easy. But when I was a day trader, it's the exact same thing I used to do. And yeah, the entry pattern is the least important thing. As long as you've got the bias right, which you determine with liquidity, and you've got liquidity sweep, you'll be fine. You will be fine. And yeah, I'm gonna give you one last example because I really want you guys to get it. And if you're watching this far, you guys deserve a treat. I'm gonna give you indices this time. Okay, so we're on US 30, Dow Jones, whatever, and this works on futures, by the way. A lot of people ask me, it works on futures, it works on CFDs, Forex, works on stocks too, by the way. It works on crypto, it works on all markets, because all markets only move for liquidity, right? All markets, crude oil, all of it, all only moves for liquidity. And that's the only reason these markets move. And yeah, obviously, the bias is really easy on that, right? We're in a bull market, and we've got this key high here, this key high right here. And if we were bearish, this order block right here is the last up close candle for the down move. Price would have respected it. And by respect, I mean price would have literally just capped at the wick and quickly moved down. And if you look here, it makes it more obvious. You see how price touches it with a wick, comes down, kind of respects it. Now, that right there isn't respect, because you need to wait for a few more candles. But if price did do this, if price capped at the wick and went like that, that right there would tell me that we're bearish. But because we're closing aggressively for it, there's no respect to the order block. That high right here, which is all-time highs, is very obvious for Dow. And yeah, we're going to get lower time frames, wait for liquidity sweep, and then we're going to enter on a fair value gap or order block. Doesn't really matter. Okay, so we're on the 5 minute for Dow, and we're just looking for any sort of liquidity sweep. And what's really important for indices, and this is so important, is that you don't really want to trade till 9:30, but 9:30 a.m. Eastern, so when the stock market actually opens, that is always a fake move. It's always a fake move. It's just there for liquidity sweep. Now, it doesn't look like a liquidity sweep in terms of, it's not like Forex where it's like a little, let's just imagine we're bearish where a little high gets taken out and it quickly reverses. It's not like that with Forex. With indices, what it tends to be, because we're bullish, is, so let's say we've been going up, and this is a 9:30 a.m. open, let's suppose. It's like a fake move, like a really aggressive fake move, and then price comes all the way up like that. And it usually retraces 10 to 11 a.m., continues up, takes out whatever key liquidity, let's say there's some key daily high, and then it'll start to reverse in the PM session, or it will just consolidate. Right, that's what indices tend to do. And this fake move, this fake 9:30 a.m. move, is like a Judas swing, whatever you want to call it. It's a fake move designed to get retail traders going in the opposite direction. It generates liquidity. And that's how you trade indices, right? You always avoid the first 30 minutes. But what you can see right here is this fake move. Remember, we're bullish on the higher time frames. We've done all the hard work. We're operating under the lens like smart money is. We're only looking for any reason to get long. Right? We're not looking for any shorts. We're only looking to get long, right? And this move right here is a fake move. Around here, you've got some liquidity here. But like, if you look at the wicks, right, the wicks do the damage and the bodies tell the story. Now, what does that really mean? It means the wicks are usually stop runs. That's what they usually are. And this low right here, there's lots of liquidity, because if you look at it, this is like the end of London. You get this large move up, then you get your retracement. So let's mark this out. Right, like this. Like that. This right here is your liquidity sweep. Right, liquidity sweep. Let's mark this out. Liquidity sweep. We always wait for this. And for indices, you gotta very, very careful, because indices can be very aggressive during the 9:30 a.m. open. And for entries, because for indices, right, and this is so important, indices are best off traded on the 1 minute really for futures, but if you're going to trade it on the 5 minute chart, I've found is you don't really get a fair value gap. I know you get it here, but it kind of gets filled before 10 a.m. Eastern, and it's not really that good. For me, I'm a big believer in order blocks. I really like order blocks indices because if you've got the higher time frame bias and you've got like a big strong order block, that order block's quite high probability. And again, the order block's also a liquidity sweep, and it's got like a little fair value gap in. But this fair value gap's already filled by 10 a.m. So what you're going to do is you're going to enter on this order block. And let me just tell you something about order blocks really quickly. And this is a gem, right? As soon as price, and because we're bearish, so this the last down close candle for the up moves your order block. As soon as this body closes above that candle there, as soon as it closes above it, that right there makes it an order block, right? As soon as the body closes above it, that makes it an order block. Not the wicks, right? Remember, the bodies actually tell the story. The body is actually smart money, right? Not the wicks, but as soon as the body closes above that candle there, that's an order block. That's a valid order block. And you see here, the wicks here are only for the liquidity sweep. But what we're going to do, enter on the order block. We're going to enter at 10 a.m. Eastern, right, for indices, because we don't enter before then, because it's a fake move. Stop loss at this low, like we always say, very unlikely price going to come all the way down, take out liquidity sweep, especially for indices, which moves very fast, right? 10 to 11 a.m., you know, the 9:30 till 10 a.m. is the fake move already, so it's very unlikely it's going to come down, take out your stop loss, go all the way up, give another retracement, and then go back up. Very, very unlikely that's going to happen. It can happen, which is why you always need your stop loss, but very unlikely. And yeah, for take profit, we're going to target at least 2 to 1, like that, or in this case, a 3 to 1. And down moves a lot, right? It moves quite a lot, so you can get a lot, and you know, you get quite a decent risk to reward ratio. Never more than 3 to 1, like we always say. And I hope you can see now from all these examples. Whenever you aim for like a 4 to 1, you kind of almost get very close, and then price starts to reverse or just consolidate. A 3 to 1 is the best. That's for me personally. 3 to 1's the best. A 3 to 1 or a 2 to 1. Right? Those two are the absolute best, personally. And yeah, that is how you trade liquidity, right? That's how you actually use liquidity to make money in these markets. And out of all the things I've studied in technical analysis, liquidity is by far the most important thing. By far the most important thing. And you know, if you follow me on Twitter, you can see I can read these markets like a book. Like, I'm not even joking. I can consistently predict where price can go, like, you know, non-stop, and it feels like a superpower. And the only reason I'm able to do that is because of liquidity on the higher time frames. And what actually makes me profitable is waiting for liquidity sweep and then entering. Because, you know, when I didn't wait for liquidity sweep, I'd always get the bias right. I would always lose, and it'd be so annoying. But to summarize, what you want to do, you want to get the daily chart or the 4 hour chart, and you want to look for key highs or key lows that price is going to go for. That is your liquidity, key liquidity pool. Then you're going to get into lower time frames. It can be the 5 minute, it can be the 15 minute, it can even be the 1 minute, and you're going to wait for a liquidity sweep. Once you get your liquidity sweep, you're going to wait for your entry, which could be an order block, fair value gap, optimal trade entry, or anything else you like. And you're going to aim for a 2 or 3 risk to reward ratio, nothing more, and ideally nothing less. And yeah, that's all you need to be a profitable trader. It's really all you need, and that's how you trade liquidity.
Can you see, let me make this really obvious. Can you see how this wick goes straight above it, aggressively goes above this high, and then drops massively, right? Can you see this? Let me mark this out for you. You see how price goes right above it, and then drops massively. Would you agree, and this is really important here, would you agree that this was a fake move? These green candles here going just above this high, take out stop loss orders, and then quickly and aggressively reversing. Would you agree that this here was a fake move, right? It was a fake move. This was not the real intention of the market to go up. Would you agree with that? Hopefully, right? Hopefully that's pretty obvious and making sense, right? This is a fake move that takes out stop loss orders, and then price massively drops in the opposite direction. And if you're ever unsure about, you know, is this a sweep? Is it or is it not? Wait for a fair value gap to form in the opposite direction, because that is the highest form of confirmation that you can get. But remember, the most important thing, the first step, is always the bias, right? You know, if I didn't have the bias, I'd be like, oh, you know, we just swept this low here, you know, is this a sweep or is this a sweep? But because I know the bias, I know exactly what I'm looking for, right? If we were bullish, we'd be looking for some sort of low to be taken. But because we're bearish, we're looking for a high to be taken. So we have our sweep. This wick here is our sweep. The confirmation is this massive fair value gap. Now that we have this, we go on to step 3, which everyone wants to skip straight to, which is our entry, right? Beautiful, bro. Look at this wick just filling the fair value gap. Right? Absolutely insane. But anyway, by the way, I saw this live in price action, right? This is live trading. And I thought, oh, you know what? Let me just make a video on this, right? Let me make a video on this. Those who don't know, I'm a swing trader now. Just because I've been day trading for years, right? And I want the free, what would you call it? The work-life balance, whatever. But sometimes I get tempted, right? Sometimes I get tempted. And I thought, I'm either going to trade this or I'm going to teach it or make a video on it. I thought, you know what? Let me make a video on it, right? I've got enough money now. Let me make a video on it. But anyway, here we go, right? Step 1, bias, which is the 4-hour low. Step 2, sweep. Step 3, entry. You can take any entry that you like. I like the fair value gap. So what you're going to do, let's just imagine you like the fair value gap. You're going to enter on the fair value gap. Your stop, really important, is going to be fixed at this high here that caused the liquidity sweep. There is no point whatsoever in waiting for a sweep if you're going to put your stop at the fair value gap or here or wherever. You have to put your stop at the liquidity sweep, high or low. There is no point whatsoever in waiting for a sweep. This whole framework will break, will fall apart, right? The bias gives you your direction, the sweep gives you your edge, and your entry makes you money. You probably want to write that down and put that on a t-shirt, because that right there was a golden nugget, right? Super important. The sweep gives you your edge. It gives you your win rate, right? Gives you your win rate. This is how you get 60, 70% win rate in trading. It's by waiting for a sweep. If you don't wait for a sweep, you're going to be one of those guys who has a 30% win rate, you know, and like a, I don't know, like a free risk reward ratio, and is barely profitable, right? After 100 trades, you know, they make $1,000, which, okay, yeah, it's fine, but they're going on, you know, massive losing streaks, you know, 10, 15 losing streaks, and most traders can't cope with that, not mentally, right? And you got into trading to make good money, be honest, right? You got into trading to make good money, not lose every, you know, like 9 trades out of 10, right? You got in this to make good money, real money, and you should do, right? So this is how you make life-changing money with trading. This is how you actually become profitable. Bias, number 1, sweep, then entry. So stop, always fix at the high. Now for take profit, and I chose an example deliberately, and you'll see why, right? I always target a 3-to-1. I always say this, just target a 3-to-1, get your money and get out of the markets, right? And this is why I always say this. This is your 3-to-1, beautiful entry, free risk reward ratio. You've got your money, you know, this is a 100K account, you're making 3K, you risk 1K, and per 100K account, you've got all your money, you're out of the market, right? You do not need to target this 4-hour low, right? You do not need to target. This just gives you your direction in the market, right? This just tells you that price is more likely, where is the path tool? More likely to go down here, right? We do not need to target. You do not need to, I cannot stress that enough. Some traders are going to get greedy, they're going to put their stop or their take profit all the way here, only to see price reverse. And I know it doesn't take you out here, but what's really happening, let's get back to the 3-to-1, what's really happening here, and this is super important, is as day traders and scalpers, what's actually going to happen here is price is probably going to go up, take out London high, which is the liquidity sweep, and then give New York traders that high probability entry on, let's say, a fair value gap stop here, and then they can ride price down. Right now, will it take out the 4-hour low? Who knows? Maybe it'll consolidate. Maybe it'll do in Asia. Who knows? Right? No one knows. But that's probably what's going to happen. So I always say this: get your 3-to-1 and get out of the market. Right? Get your money and run, because these markets are nasty and they can reverse quickly. And to be honest, all you need is a free risk reward ratio and even a 50% win rate, and you can become a millionaire with that very fast. Actually, it might not seem like that. But, you know, you do 10, let's say you've got 10 trades on a 100K account, risking 1% per trade, right? You lose 5, that's minus 5%. You win 5, which is plus 15%. That gives you 10% overall in a month, right? 10% on a 100K account, 10K a month. There's your 10K a month. Very realistic, right? Very realistic, especially if you're using this setup. You know, minimum 50%, but you can get a higher win rate. Okay, so now that we've got our liquidity sweep, all we need now is a simple entry, and literally any entry pattern, any indicator that you like, as long as you've got a sweep, will be high probability. So once we got the sweep, all we need is a simple entry pattern. Now you can take this fair value gap if you really want to, if you like trading fair value gaps. But for me personally, I like order blocks. I like Fibonacci retracements. And in this case, we've got a nice, beautiful order block right here, right? Because if you trade fair value gap, you're gonna have to ask yourself, which one do you take? You know, ideally you should be taking the lowest one, but in this case, you don't even get tagged in. And it's the 1-minute chart too, right? So for me personally, I'm going to take this order block here, this nice juicy order block like this, right? So this is our order block we're going to enter on. And like I said, really does not matter. As long as you've got the sweep, really does not matter wherever you enter. But what does matter is where you put your stop loss. The only reason we wait for a liquidity sweep, this is really important. The only reason we wait for a sweep is so we have a safe place to put our stop loss. So we're going to put our stop loss always at this low here, because this is the low that caused the liquidity sweep, right? Let's just zoom out right here. This is our liquidity. This move right here was a sweep. The The only reason we wait for a sweep in the first place is to have a safe place to put our stop loss orders. There is no point whatsoever in putting your stop here or here because you're going to get wicked out, right? You're going to see price come like this and just wick out your stop loss and then go straight to take profit, right? The only reason we wait for a sweep is so we can have a high probability place of putting our stop loss orders or our stop loss order at. Right, so if you don't put your stop loss at this low here, there is absolutely no point in waiting for a sweep. You may as well just ditch it. There's no point in doing it. You have to have your stop loss at this low here because it's very unlikely, because price has come down and taken out liquidity over here. It's going to go all the way up, come all the way back down, take out your stop loss and then go straight to take profit because it's already done that, right? So super unlikely that's going to happen. What is likely to happen is this, right? So you get your high probability retracement, and then for your take profit, you're going to target, for me, I'm going to target minimum 3 risk to reward ratio, right? Minimum 3 to 1. Or if you want to target, or if you want like a really good entry, target the opposing liquidity pool, right? Which would be this high right here. So if you've taken out an old low, target the old high, right? So this would be, what's this? London's high, right? So you can target London's high for an easy 4.5 risk to reward ratio. Okay, so liquidity is simply stop loss orders, and the only reason these markets move is for liquidity. Now, the reason why that is because it allows smart money, big banks, big hedge funds to get in and out of their positions, because where there are stop loss orders, there's going to be money. So to determine liquidity, what we do is we get on the 4-hour chart. Now, you can use the daily, the weekly, and even the monthly, but to be honest, just use the 4-hour chart. We have to use a higher time frame because that gives us the overall direction of the market, or a bird's eye perspective, if you would like. But you get onto the 4-hour chart, and what you do is you simply ask yourself which major high or low is price most likely to go for. So right now in price action, we're at this point here. So you're going to ask yourself, right, you're going to look to the left hand side of the chart, is price more likely to come up and take out this high here, where there's lots of stop loss orders at, this high here, or is price more likely to do this? Is it more likely at this point right here to come all the way down and take out this major low here, right? Which one is more likely? Hopefully it's pretty obvious, right, that price is more likely to come up and take out this high right here, or these highs right here, right? Price is right next to it. There's no respect of any bearish order blocks, bearish fair value gaps, right there. So what does that really mean then? What does that really mean? If we're at this point on the charts, we know that price wants to go for these highs here. What does that mean? It means one simple thing. It means we are bullish and the markets overall are bullish. So the highest probability trades are going to be looking for longs. Now at this point here, we get onto the lower time frames, or our entry time frames. Okay, so now that we've got our direction, we need to wait for a liquidity sweep. Now what a liquidity sweep really is, it's just a stop run. Now you might hear a liquidity sweep be called a liquidity purge, grab, run, and ICT calls it a Judah swing. Whatever name people want to call it, the reality is it's simply a stop run, right? It's a fake move in the opposite direction of the overall market. Now, really important here, the only reason liquidity sweeps actually work is when you've got the overall direction. Now, if you remember from the beginning of the video, and this is our 4-hour liquidity right now. If you zoom all the way out, you'll find the high all the way over here. But this is our target. This gives us our direction. Now, can you see how price is right here? It's ready to go up. It drops massively. It takes out stop loss orders here, here, and here, which is also London's low, so the previous session's low. And then it quickly and aggressively shoots off in the opposite direction. That right there is a liquidity sweep. And the highest probability trades always occur after a liquidity sweep. Super important. If you do not wait for a liquidity sweep, you will see your stop loss get hit, only to see price then go to your take profit. And it's very annoying, and it held me back for 4 years, right? 4 years I could not make money because of this liquidity sweep. Now, the easiest way to spot a liquidity sweep is to wait for a stop run, right? So we see these lows here. We've got one low here, one low here, one low here, which is also London's low. So wait for the sweep, wait for price to come and take out stop loss orders, and then wait for a fair value gap to form in the opposite direction, because that right there will give you, that right there is smart money literally screaming at you once this fair value gap forms right here. Once this fair value gap forms right there, that is smart money screaming at you that this is a liquidity sweep, this is a fake run, fake move, and that price is quickly and aggressively going to reverse in the opposite direction. Okay, but last but not least, all we need now is a simple entry. We have our direction on the higher time frames. We have our liquidity sweep, which should always be on your entry time frame. If you trade the 1 minute chart, do not wait for a liquidity sweep on the 1 hour chart. It must always be on your entry time frame. Now, the reason for that is the only reason we wait for liquidity sweep is so we can put our stop in a safe area. So for your entry, you can use literally any entry pattern, any indicator that you want, assuming you've got the direction, which we use on the 4 hour chart, and you have the sweep. Once you have those two, any entry pattern will do. You can use the fair value gap. The stop loss is quite large here because the stop loss must always be at the liquidity sweep low, which is really just this low here, right? The fake move, the low that causes the fake move is here. It should always be fixed at this low here. There is no point waiting for a sweep if you're going to put your stop all the way over here. The only reason we wait for a sweep is so you can find a high probability place to put your stop loss. So you can enter using the fair value gap and target, whatever you want to. The stop loss is quite big here. So for me personally, what I use after 5 years of trading, the only thing I still trust after, obviously having the direction and the sweep is a simple Fibonacci optimal trade entry, retracement, whatever you want to call it. I enter at the 0.705 level here, just so I don't have to guess what fair value gap, what order block I can take. I simply enter here like this, stop always at the liquidity sweep low, and then I simply target a free risk to reward ratio like that, and we hit it like that, and you will see this right here is the highest probability setup you will find in all of trading. And I can honestly say that after 5 years. Find liquidity on the 4 hour chart, that gives you your direction. Wait for a sweep on your entry time frame, and then look for any simple entry pattern. If you do that, I guarantee you will become profitable more faster than you could ever imagine. Now, this trading strategy is as easy as it gets. There's only 2 time frames that you need to use, and the first one is the 4 hour chart. Now, we only need to use the 4 hour chart to simply mark out a fair value gap. There's no complicated daily bias. All you need to do is get on the charts for gold and just simply mark out the most recent fair value gap that forms in price action. It can be a bullish or bearish fair value gap. It really does not matter. All you need to do is simply mark the 4 hour fair value gap out on the market, and all you need to really do is see, okay, what actually happens when price hits this fair value gap on the 15-minute chart? Is it going to hold, shoot off, and give us a retracement? That's what we want to see, right? If we see this on the 15-minute chart, this is going to be our entry. However, if we see this, if price just smashes right through this fair value gap on the 15-minute chart, there's no entry. And similarly, if price hits this fair value gap, and be honest, you've seen this before where the market just consolidates for ages. If that happens, we're not trading that either. So we're done now. We're literally done on the 4 hour chart. All you need to do is simply mark out a fair value gap, wait for price to hit the fair value gap, and then when you have that, you simply go down onto the 15-minute chart. Now, you can use the 5-minute or 1-minute chart, but the traders who get the best results use the 15-minute chart, because the 4 hour chart and 15-minute chart is a money maker. It's an absolute money maker. Obviously not guaranteed, but it's as close as you can get, right, in trading. So here's the 4 hour fair value gap that we have. Let me just quickly mark this out for you. This is the one that we just marked out on the higher time frames. What we have here is price hits the fair value gap at key time of day. If you look right at the bottom of the charts, this is Asia session, right, 8 p.m. What we're going to do, remove this off. Now, can you see how price hits the fair value gap and slowly starts to move off? Now, we need an entry. We need a high probability entry that we can trust and that we can use to become consistently profitable with this strategy. So instead of me giving you some vague, oh, enter here, simply to mark out the first 15-minute bullish fair value gap that forms, right? Now, the reason it's bullish, right, think about it. Why do we want the first bullish fair value gap that forms in price action? The reason we want that is because this 4 hour fair value gap is also bullish. So if you have a 4 hour bullish fair value gap, you want to see a 15-minute bullish fair value gap. And similarly, 4 hour bearish fair value gap, you want to see a 15-minute bearish fair value gap. So you'll be surprised, right? I bet you're probably kicking yourself if you haven't seen this strategy before. You'd be like, is this actually going to work? Again, as always, back test this, and you'll be so shocked to see how see your win rate, right? It's absolutely insane. All you need to do is enter on this 15-minute fair value gap. For your stop, you can put it here if you really want to, but you don't really need to, because on the 15-minute chart, there's not much messing around, right? You can have a really good stop loss. So the minimum your stop must be is this candle here. Now, why is it this candle here? Let me move this down a slight bit for you. The reason it has to be at the low at this candle is this is the candle that forms a fair value gap. Now it's 3 candles that form it. This is the lowest candle that forms it, so our stop has to be minimum at this low here, which is absolutely fine. On the 15-minute chart now, what we're going to do now is I'll take profit, right? All we need to do is target either 3 to 1. This is what I do, right? So if you want the easiest, absolute, no thinking whatsoever, Atif, give me the absolute easiest trading strategy that even a 10-year-old could follow. Literally 4-hour fair value gap, 15-minute fair value gap, enter on the fair value gap, 3 risk to reward ratio. There's no thinking whatsoever. Like, be honest. Hopefully this is probably the easiest trading video you ever watched, man. Like, it actually works. I genuinely want you to change your life using this trading strategy, man. Like, it works, bro. Like, it works. But here we go. So if you want to make the absolute most that you can on the day, what you want to do is you want to target previous session or previous day's liquidity, which is this level right here. And then that's it, you're done. And there might be more liquidity all the way over here. Is there? I don't know, right? Sometimes there might be more liquidity all the way over here. Don't get greedy, right? Just target previous day's liquidity and you're done. For what, 4.74 risk to reward ratio. Probably the easiest strategy you've ever seen. So if you want to fix your trading psychology, you're going to have to fix your mind, right? Now, your mind is going to be represented by this circle here, and it's divided into 2 parts, right? You've got the conscious part of your mind and the subconscious part of your mind. Now, the conscious part of your mind, this is the logical part of your mind, right? This does all the thinking. This stores all your knowledge about trading, liquidity, ICT, indicators, daily bias. All of that is within the conscious part of your mind, right? And then the second part of your mind is the subconscious mind, right? This is the emotional mind. This stores all your emotion, right? Your FOMO, fear, greed, discipline, all of that is within your subconscious mind, right? So your mind is divided into 2 parts. Now you might be wondering, why am I telling you this? And it's for this simple reason right here, which changed my life, right? 95% of your actions come from the subconscious mind, right? Comes from the subconscious mind, not the conscious mind. So what that means, and bear with me here because this is so important. 95% of your actions come from the subconscious mind. And if you remember, your subconscious mind is the emotional part of your mind. It doesn't have any of the logic. It doesn't have any of your knowledge of liquidity, of ICT, of indicators. It doesn't have any of that. All it has is emotion. Right, so 95% of your actions come from the subconscious mind. So it doesn't matter how much you know about liquidity, daily bias, ICT. If you can't fix your subconscious mind, you're never going to make money. And this is what happened to me. Within 2 years of trading, I had mastered technical analysis. I knew everything about liquidity. I could predict price on almost any asset, and I couldn't make money. I could not make money for 2 years. I understood trading, and for 2 extra years, I didn't make a single penny from trading. In fact, I lost so much money, and it was so just demoralizing and humiliating because I knew so much and I couldn't make money, and I was a laughing stock, bro. I was a laughing stock from all my mates because I was the most wise, knowledgeable, broke guy you'd ever met, and I don't want that for you because it took 2 more years of me having a model that worked but not making money, all because of my subconscious mind, right? And your subconscious mind has all of your emotions, FOMO, fear, and greed, and whatever is the dominant thought in your mind, whatever's the most dominant thing in your mind, comes and gets expressed through your body, right? Now what that means is, let's say, because 95% of your actions come from the subconscious mind, if your overall mindset is, I'm afraid to get into trades, or I'm greedy, I can't, whenever price comes to my take profit, I just have to move my take profit because I'm not satisfied with enough, or you over leverage, that is the most dominant thought in your mind, right? And what happens there is that gets expressed in your body, and that will control your actions, right? And then that controls your results or P&L. So what that means is, let's say you're afraid, like I was, right? For years, I was afraid to lose. Like, for whatever reason, I could win trades fine, but whenever I lost, I was so scared to get into a trade. Like, I was scared to get into a trade. As soon as I saw any sort of drawdown or, price reversing against me, I'd panic, I'd close my position, I'd move my stop to break even. And what was actually going on is, deep within my subconscious mind was this fear. And I don't know, it could come from childhood, past trauma, it doesn't really matter. All we know is that it's there, right? This fear, right, was in deep with my subconscious mind. And if you remember, 95% of your actions come from the subconscious mind. So my body and my actions would always be someone afraid to lose, right? So I was afraid to even get into trade. I'd see my setup and I wouldn't even take it because I was so afraid. And then what that meant was I'd missed so many winning trades, and my results were I made no money.
Now, broadly in trading, broadly speaking, there are 2 things that will hold you back. The first is fear, and the second is greed. Right, and usually people fall into one of 2 categories. They're either very fearful, they're very hesitant, they don't want to get into trades, They hate losing, and when they go on a losing streak, they start panicking, they get anxiety, they want to change models, and that's exactly what I was like. Right, that's exactly what I was like. I was such a fear-based trader, and I'd be scared to lose. And as soon as I lost, I'd be like, oh, I've done something wrong. I need to change my model. I need to change my model. And that held me back for years, really. It held me back for years. I was very fearful. I'd be hesitant to take trades. So let's say I lost a trade, right? And my trade usually was like a fair value gap here. So like I would enter. I mean, this isn't my model, but let's just say this is my model, right? And let's say I'd lost, let's say, 3 trades before. I'd had a 3 losing streak, and this is my model. I would not execute it. I'd be so scared. I'd be here, and I'd be so scared thinking, oh, what if price like goes up and takes me out and then goes back down again? Like, what happens then? Like, that is how I used to be. And that is how fear-based traders are. That's how fear-based traders are. They're very hesitant to get into trades. They hate losing. When they lose, they think they've done something wrong. They want to change things. They want to fix things. They usually, in my experience, they tend to be like perfectionists, right? They may have excelled at school, university, work, whatever they've done. And when they get to trading, they want to control everything and they want everything to be perfect. And that is what holds people back, in terms of fear, the hesitation and the anxiety that goes with it. And the second one, so if you don't really relate to fear, if you're not really like, anxious to get into trades, if losing isn't that big of an issue for you, you might fall into the second category, which is greed. Right? A lot of traders fall into greed, which is they're greedy, they want to make money, they're not disciplined. They don't follow their trading plan, they over risk, they over leverage. So let me give you an example. I know a lot of people on Twitter, they ask me about this because they've got, FOMO, greed, that sort of stuff. Fear of missing out is an element of being greedy, right? It's an element of being greedy because you can't accept what your model gives you, right? Because if you follow your trading model, you've got your trading plan and you follow it every single trade without hesitation, there is zero thing as FOMO. You should have no FOMO because it's not your trading model, right? Like, I'm a swing trader. I don't care what a scalper does on the 1 minute chart on gold. Like, I don't care. Even if that guy makes like 10K in a day, that means nothing to me because it's not my trading model. I have no FOMO. Whereas people who have greed, they think, even though they've won today, let's say they've won a trade, they think, oh, well, this guy made more money than me. They made more money than me. Let me get into a trade. And, they struggle, they lack discipline. They struggle to follow their plan. And the reality is they're just focused on making money. They're focused on making money too much. And they'll do anything they can to quickly make money. And when you try and quickly make money, you quickly lose money. So like an example of a greed-based trader would be, you see this fair value gap here, right? Let's make this a bit bigger. Let's say their entry was this fair value gap. And they're on the charts at this point, right? And they see price coming down, and there's no retracement. They see no retracement, right? So price has come down like this. It's come down like this. And they think price is not going to come up and give them a second chance like it's done it. They don't think that's going to happen because for whatever reason, they're greedy. They think price is going to come all the way down. They think it's going to keep going down. It's going to keep dropping. It's going to keep dropping. It's going to take out, liquidity here. It's going to keep going down. And they don't even think about the possibility of losing because to them, it's all about making money. And what they'll do is, let's say price is here or it's like around here. Their entry really is supposed to be up here. That's what it says in the entry model. But they're like, oh, you know what? Screw it. I'm just going to enter here and I'm going to target all the way down here. And they target all the way down here. Price, slightly goes in their favor, quickly reverses. It stops them out. And then it goes to their entry. And then usually what happens is their entry is actually right. And it goes to take profit. And then they're angry. They start revenge trading. They start changing the model. This is what a lot of greed-based traders have. They have this sort of issue where they can't follow their model. They're chasing price. They don't have discipline. They can't wait for it. Maybe they follow their model for a week and then they give it all back, on one trade, the next week after because they can't follow their model. And, greed at its core, it's a lack of discipline. It's a lack of discipline. So for greed, the key thing is you have a lack of discipline in yourself. You can't follow your model. Because you have a lack of discipline. Whereas with fear, the key thing there is a lack of confidence, right? With fear, it's a lack of confidence. With discipline, with greed, it's a lack of discipline. Right? I hope that makes sense. Because that's very, very important. Fear-based traders don't have confidence in themselves. They don't have confidence in their model, and they don't have confidence in the markets in general. Right? And that was for me. I had, a huge problem with just not having confidence in my model. Like, I'd lose 2 trades in a row and I'd be like, oh, what if I lose again? What if I lose the next 5 trades? Like, this is what I would think, right? Because I didn't have confidence in myself. right? And it's very, very important as a trader you have confidence in yourself, because eventually you're going to be putting real money on the line, and depending on how big your ambitions are, your stop loss could be $1,000, $5,000, $10,000, right? If you want to make 10K in a day and you've got a free risk to reward ratio, you're going to be risking $3,000. $3,000 is a lot of money, and you need to be at a point where you're confident enough to risk that money and lose that money. Right? If you lose a trade and it's $3,000 stop loss, that shouldn't bother you. Eventually, that will not bother you. So, you've got to be at a point, if you're a fear-based trader, where you're confident in yourself and you're confident in your model. And if you're a greed-based trader, if you're greedy, you like chasing price, you get FOMO, you need to develop discipline. Okay, so now we're getting into the meat of the video. This is absolutely gold dust. And, if you watch this far, because so many people will just click off in the first minute, but if you watch this far, this is so important. This is what's actually going to change your life. We have something called a self-image, right? Your self-image, let's mark this out. Your self-image here is buried deep within your subconscious mind, your childhood, and even, all your life experiences. You would have heard stuff. And this is why most people don't make any money online, is because you would have heard stuff. Money doesn't grow on trees. Money's hard to get. You need, I made a money. All that sort of stuff goes into your self-image. And your self-image, in this case, the money, that money's really hard to get, right? When it's not, right? It's actually really easy. It's really easy to get once you know what you're doing. Once you've got this in your mind. But your self-image is so important. Your results are all dictated by how you see yourself subconsciously. Not if me and you were in a room and I was like, hey, what do you think of yourself? Oh, I'm a confident guy. I know how to trade. It's not what you would say to me. It's not what you want other people to, think about you. It's not what you want, right? It's what you deeply believe in your subconscious mind, right? Without even thinking. How do you actually see yourself? Yeah? Because, a lot of you see yourself, and even I was like this. I saw myself, almost a bit of a pussy, right? I was afraid to lose. I was scared, scared to get into trade. I was deep within my subconscious mind. Deep within my subconscious mind also was that money was really hard to make, and it was hard to get, and it was hard to keep. All that sort of stuff held me back for ages, because within my self-image, I had all these negative traits. Now, this video is just about trading, and I wanna literally, and if you watch my videos, I'm all about no BS, practical solutions. Let's fix the problem. But I need to tell you guys what's holding me back, and then I need the solution, because the solution is very easy, very bizarre, but really easy. So here we go. Your self-image, and this was me for ages. I guarantee you're saying things like this. I want to be a profitable trader. Here we go. Do you know how it's want? Not I am. I want to be a profitable trader. I lack discipline. I'm afraid to lose. Yeah, I used to do this all the time, right? When I'm profitable, I will do this. When I'm profitable, I'm gonna live in Dubai. I'm gonna get into property, like all that sort of stuff. This was me as well. One day when we're rich, like how many times have you and your mates done that? One day when we're rich, we're gonna be here. We're gonna do this. We're gonna do this. Right? When you keep saying this, what you're really saying to your subconscious mind is, I am not that person already. I am not a profitable trader. That's all we care about in this video, because we're talking about trading. All we care about is being a consistently profitable trader who makes money. That's all we care about in this video. Right? I might give you a few golden nuggets about money and maybe even women later on, but this video is purely about trading, right? For the most part. So here we go. All we care about is being a profitable trader. Now, your subconscious mind has no ability to think. It cannot think for itself. Your conscious mind does all the thinking for you. Right? That's where all your knowledge is. It does all the thinking for you. The subconscious mind just accepts whatever goes into it. It accepts, and it turns into result. It manifests into result. Right? Key word there. It manifests into result. That's what manifestation really is. And most people have no idea what they're talking about with manifestation. Here we go, right? When you say things like, I want to be a profitable trader, I lack discipline, I'm afraid to lose, and when I'm profitable, not I am profitable, when I'm profitable, one day, what you're always telling your subconscious mind is, I am not a profitable trader. I'm not a profitable trader at all. Now, your subconscious mind cannot think, so it thinks, oh, well, Atif, right? Me, oh, he doesn't want to be a profitable trader, so what he wants is he wants me to be, he wants me to keep him as an unprofitable trader, right? For some reason, he likes studying, right? Yeah, that's what, whenever my mates would ask me, and you probably have this too, oh, what are you trying, what are you doing? What are you doing? Oh, I want to be a profitable trader. I want to be a trader. I want to be a trader. Your subconscious mind is going to keep you as a guy who wants to be a trader, right? This is so, if you can really understand this, you can easily change it. Your subconscious mind is going to keep you as someone who wants to be a trader, right? Oh, this is his identity. Because that was my whole life for years. That I'm a guy trying to learn how to trade. Well, if you're a guy who's trying to learn how to trade, you're going to be forever a guy trying to learn how to trade. Because your self-image and your subconscious mind, it's going to see that. It's going to see that you get really emotionally involved, right? That you're really passionate about it. That, oh, this guy, for whatever reason, he really wants to be a guy who learns how to trade. He wants to be a guy who wants to be a profitable trader. He doesn't actually want to be a profitable trader. Your subconscious mind is going to think, oh, he enjoys watching YouTube videos. He enjoys reading books. He enjoys, learning about liquidity and all that. it might be interesting, but at the end of the day, we want the result. We want the P&L. We don't want blown account, right? But the only way we can do that is to not identify any of this crap here. Like, I get so many people saying to me, I'm afraid to lose. Now, when you say I'm afraid to lose, your subconscious mind thinks, oh, I want to lose. Right? I want to lose. Let me keep making this guy lose, right? Let me keep making this guy lose. Here we go. I lack discipline. Let me this up. I've got 18,000 followers. I get hundreds of DMs from traders every single day. And I get to this sort of stuff all the time, right? Where I say, I'm afraid to lose. I lack discipline. How many people say this? Oh, I'm good at trading. I just lack discipline. But when you say that, it goes straight into the subconscious mind. Straight into the subconscious mind. And your subconscious mind will dictate 95% of your results. So when you have that in your subconscious mind, you lack discipline and that you're afraid to lose, that one day you'll become a profitable trader. And when you keep saying stuff like that, when you say one day I'll become a profitable trader, well, that one day is never going to come, because your subconscious mind is going to keep you as a guy who's waiting for that day to come, right? It's very stupid, your subconscious mind. It has no ability to think for itself. And I'm telling you, every single successful person that you know, anyone, Donald Trump, Elon Musk, anyone, they all are using the law of attraction. They're using the law of attraction because it's rooted in science. It's absolutely key, because what's actually happening, and I guarantee this is what's holding you back, right? It's let me smart this out so it's clear. Your self-image, and this is such a key word, this is absolutely key. Your self-image will determine your results, right? And your self-image, let me just write this down, it's determined within your subconscious brain. Your self-image is in your subconscious brain. Do you remember how I said right at the beginning of the video, and it might have sounded weird, if someone asked me if I wanted to be a profitable trader, I would have said yeah, because logically, if I asked you, do you want to be a profitable trader? You'd be like, yeah, of course. Like, of course, I want to make money. Subconsciously, though, that's not the case. Your self-image is this. Your self-image is this. You see yourself as someone who wants to be a profitable trader, someone who's trying to learn how to trade. Right? Your subconscious brain, remember how it has no logic to it. It cannot understand. It thinks that you want to be someone who enjoys learning how to trade, right? You have to convince your subconscious brain that this is your self-image, right? Even if it's not a reality yet, right? Because remember, the results come after it's in your subconscious brain. If you want to be rich, you need to convince your subconscious brain that you are rich first. Then the money will come. You can't keep saying, oh, I'm a guy who's trying to be rich. I want to make money. You have to say, I am a guy who has money. And then by law, the law of attraction, it must come. The exact same way, if you want to be a profitable trader, you can't keep saying, oh, I want to learn how to trade. One day I'm going to be profitable. One day I'm going to be a millionaire. One day I'm going to be funded with FDMO. You have to say, I am a profitable trader. And you have to say that so it's inside your subconscious brain. And then once it's in your subconscious brain, by the law of attraction, it must manifest. It must come true. And if you're wondering why this actually works, your subconscious brain, as it does 95% of your actions, it will force you to have the good habits of a profitable trader. Because you already know what they are. Following your model, A+ setup, risk management, all that sort of stuff. You know consciously, right? If I told you consciously, you know the habits of a profitable trader, right? It's no magic. You know it. You know what it is. But emotionally, on the subconscious part, you can't do it. All your FOMO, let's just mark this out. All your FOMO, all your greed, all that sort of fear as well, all that sort of stuff is in the subconscious brain, right? And greed too. All of that is in the subconscious brain. Because if I said to you, hey, do you enjoy having FOMO? You're going to be like, no. Do you enjoy being a greedy trader? No. Do you enjoy being a fear-based trader? No. Right? It's all rooted within your subconscious brain. And remember, 95% of your results and your actions are within the subconscious brain. Right? It's within your subconscious brain. It's all within there. And when people say, when they have a paradigm shift, when they say everything clicked for me, they're not talking about technicals. They didn't discover a holy grail. They discovered themselves. Right? I'm telling you, the moment I started saying, I am a profitable trader, within a month, I was on a winning streak. Now, I didn't know whether I was going to go on a winning streak and then start losing again. Within 2 months of me starting to write this, I could easily say that I was a profitable trader. And my only goal was looking for capital at that point. I was just looking for money to manage. And, I turned to this, right? Probably my lowest moment in my life. I was absolutely broke. I spent a year and a half. I'd put my heart and soul into learning how to trade. I understood it on a conscious level. I knew all the technicals, all the analysis, all that sort of stuff. But on the subconscious level, I just couldn't do it. And the results weren't showing. Right? All my results were negative. The reason why they were negative is because inside my subconscious brain, it kept seeing me as a guy who wanted to learn how to trade. If you asked me, hey, what do you do? What do you do? Oh, I want to be a trader. I'm trying to learn how to trade. I never said I am a profitable trader. Right? And because I never said that, my subconscious brain, because it's determined by emotions here, because it's determined by emotions. There's so much emotion behind this. It just thinks that you want to be a guy who's learning how to trade. And we have to convince your subconscious brain that you are a profitable trader already, and then the results will show. So I'm going to show you how you can actually do that, how you can actually convince your subconscious brain that you are a profitable trader. I'm going to give you a solution, right? And this is the key solution. It's journaling. And I know people don't like to journal for whatever reason, but what a journal really is let's say we have the example, right? The trader who was supposed to enter at this fair value gap. He was supposed to enter this fair value gap, and for whatever reason, he sold price down here, chasing price because he couldn't wait for a retracement up. You would get your snipping tool up. Don't know if you guys can see this. Let's just type it in here, right? You'd get your snipping tool up. I'm not going to actually do it. You'd get like whatever screenshot software you want. You'd take a screenshot of this. You'd put it on a Google Docs, and you just type, here is a trade, which I did not wait for, right? I chased price, and price quickly reversed. It took me out, and I should have waited here. And you write that down in a journal, and you write down how you were feeling and why you did that. Right, so you might write down like, oh, I got into the trade because I thought it wasn't going to come up. I thought it wasn't going to come up. And then what you'll see is, let's say you journal for a few weeks, you'll read it back and you're like, oh, it's just a lack of confidence. It's just a lack of, almost experience, right? Because if you think about this, if you see this enough times, you'll be like, oh, if I just wait for a retracement, then I'll be fine. So what you'll see is, in this instance, chasing price is just a lack of almost experience with your model. And the cure for that is backtesting. Backtesting is so important, because if you backtested this 100 times, you're going to realize, oh, well, every time I wait for retracement, I'm profitable over the long run. Where every time I chase price, I lose right away. All right, so that's where a journal comes in. And if you're a fear-based trader, and again, we're going to use the analogy that this is your entry, and usually what your model says is that your stop loss should be, let's say here, like that, and your take profit should be down here, right? Whatever, 6-1, whatever. Entry doesn't matter, but for whatever reason, you've lost 2 trades and you're afraid to get in. You're afraid to get into this trade because you think, for whatever reason, it's going to go up like that. And we're in live price action now, so I don't know what's actually going to happen. But let's just suppose it does this. Let's suppose it goes straight down to your take profit. You're going to journal this, and you're going to be like, due to the previous trades I had, I was nervous, I was fearful, I didn't have confidence in myself, and I was too scared to get into the trade, and now the trade's quickly gone off without me, and it's hit my take profit. Right? That's what you will journal. And then you'll realize over time, over reading your journal, that, oh, it's just a lack of experience, really. It's a lack of experience in my model. Because if you've seen this, again, we're going to go back to backtesting. If you backtest this 100 times, do you know more often than not, when price retraces to a fair value gap and you're bearish, you tend to make money, you're going to execute it. You're going to execute it. So the solution almost always tends to be more backtesting, get more and more confidence. And you don't just backtest once, right? The first initial backtesting is to get your data. So like when I first backtested my model, it was a 50% win rate, 3 risk to reward ratio. That's like the actual data that you have an edge. And then afterwards, you keep backtesting to get the experience, because the more and more you can train your eyes, the less likely you are to do emotional things like fear and greed. And yeah, backtesting and journaling are so key. I know people hate journaling. I know they hate backtesting. It is tedious, but I'm telling you, please, if you just take a screenshot of this and you just write like a sentence or two, that will help you out so much. Because I realized, like, I had no idea about any of this, but I read my journal. People told me to journal, so I journaled and I read it back, and I was like, man, every time I lose, I go into a tailspin. Like, I'm so afraid of losing. And what that is, really, at its core, is a perfectionist. Right? A perfectionist tries, because, I'll be honest, everything I've done in life, and not to sound arrogant, like I tend to succeed at. I tend to be like almost the best. So for me, being a trader and losing 50% of the time, but still making money, that for me is very hard. Because for me, my brain sees success as winning, right? High win rate, 80, 90%, 95%, let's say. Because if it's an exam, usually I'm getting, high 80s, low 90s. So for me, 50% win rate, that doesn't really, go well in my brain, because it's like, I'm going to lose quite a lot. I don't like losing. So for me, fear was such a huge issue because I was a perfectionist, and I had to let go of that. I had to let go of that perfectionist. I had to accept, humble myself, really, that, I'm going to lose a lot. And the real loser in trading, it's not price going against you, right? So let's remove this. The real loser in trading, and this is so important, because if you can get this, you can truly be profitable. The real loser in trading isn't, let's say this is your model, it isn't this. That's not a real loser. The real loser is two things. It's either you not getting in the trade because you're so afraid that price is going to go against you, or price literally going down like this and you're too impatient, undisciplined to wait for retracement. So you're just going to enter as soon as possible. You're just going to enter here randomly, buy it, just randomly sell and target all the way down there, and then price goes against you. That right there, those two scenarios is a real loser in trading. That's a real loser in trading, right? But price, you following your model and price actually doing that, that's not a loser. That's not a real loser, because that's exactly what you expect. Because if you truly understand what a win rate is, because let's go off the analogy, you've got a 50% win rate and a free risk to reward ratio like I have, right? That right there is enough to make you a millionaire. That's enough to make you a millionaire, 10k a month, 100k a month, a million a month, or whatever you want. But let's just go off that analogy. You've got a 50% win rate. What that really means, what it truly means, is you have a 50% loss rate. Right? No one talks about this. Everyone talks about win rate, but what's your loss rate? You're going to lose 50% of the time. Right? You're going to lose 50% of the time. 50% of your trades are going to hit your stop loss, not your take profit. And you've got to accept that. You've got to actually accept that. If you don't accept that, you're never going to be profitable. You're never going to be profitable because, even for me, like, I'd back test it and have a 50% win rate, 60% win rate, and then, as soon as I lose like a trade or two, I'm like, oh, I need to change something. Why? Why do you need to change something? Right? You got to trust your back testing. You got to trust your edge. You got to trust your data, because you don't have data on your emotions. You don't have data on your emotions, but you have data on your trading.
Now, if you've watched my channel for a long time, you'll know I'm big into solutions. How do we actually fix this? Right? What is the solution? Now, I'm going to save you 4 years of pain, and there's one simple solution that you can do. And it's an affirmation. Now, an affirmation is something that you say and that you write down repeatedly over time. Now, it might sound absolutely insane, this, but like I said, check out the comments. People are doing this and it actually works. This is what made me a profitable trader within 3 weeks. And what you're going to do is you're going to write this down. You're going to write this down. I am so happy and grateful now that I am a profitable trader. Let me spell this right. Now that I am a profitable trader. And you're going to do that, and you're going to do that repeatedly over and over and over again, right? And this isn't some woo-woo BS that I've made up. This is exactly what I do on a day-to-day basis. In fact, what my notepad right here, I don't know if you can see that, right here, full A4 notepad of just writing the same thing over and over and over again. Now you might be asking, why do we do that? Why do we say the exact same thing and write the exact same thing over and over and over again? Now, the reason we do that is because the way you communicate to your subconscious mind is either two things. It's repetition and emotion, right? Repetition and emotion. Now, I'm not going to get, because I want this video to be short, because I know so many of you need help with trading psychology, but for whatever reason, you hate watching long videos on psychology. So I'm going to keep this really short. All you need to know is that in order to get something into your subconscious mind, which determines 95% of your actions, is we need repetition and emotion. So if you say this over and over and over and over again, over time, it gets into your subconscious mind. And once it's in your subconscious mind that you are a profitable trader, which is our desired result, the FOMO goes, the fear goes, the greed goes, because you can't have two ideas, thoughts in your subconscious mind that contradict each other, right? So if you're a profitable trader and you're afraid to lose, those two things don't make sense, right? They don't make sense. Now, eventually, the stronger one is always in control, right? So right now, or at least for me when I was unprofitable, me being afraid to lose was way stronger than me being a profitable trader. But I kept saying this over and over and over again. What happens is this idea of me becoming a profitable trader gets bigger and bigger and bigger. And this, idea of me being a losing trader gets smaller and smaller and smaller. Eventually, you being a profitable trader comes ahead of being a losing trader. And then you being an unprofitable trader just goes. It literally just eliminates overnight. And that's when people say, oh, I was trading for 3 years and it clicked within 3 weeks. This is exactly what they're talking about, whether they understand it or not. This is exactly what they're talking about, because in your subconscious mind, you can't believe that you are unprofitable and keep saying this over and over again, right? Eventually, something's going to give. And before you know it, your actions are a profitable trader. And if you act like a profitable trader, you think like one, you feel like one, you will become one, and it will show in your P&L.